Call the meeting to order. Cynthia, how are we?
We're good. We're ready.
We have a quorum?
Yes, we do.
All right. So the meeting is called, let me find my agenda here. Just wing it. All right, we have a full agenda today. First thing I'd like to do is provide for non-agenda public comment. I have two speaker slips. One is from Araceli De La Rosa. One is from Jordan Fine. As I say, we have a full agenda, and we've heard from Unite here many times. This is not a political body. We're pleased to hear from you, but if you could keep your remarks as short as you can and deliver your message, we'd appreciate it.
Keep them to the time that's allotted.
You insist, sir. Please proceed.
Okay. Mi nombre es Araceli de la Rosa. Trabajo en el Irvine Marriott como recamarera.
My name's Araceli De La Rosa, and I work for the Irvine Marriott as a housekeeper.
Yo participé activamente en organizar la unión con mis compañeros en el hotel desde el principio del 2018, noviembre.
I
Perdón.
actively participated in organizing the union with my coworkers at the hotel since the beginning of November 2018.
El miércoles 12 de diciembre nosotros decidimos activar la elección por la NLRBD. La elección, perdón.
On Wednesday, December 12th, we decided to file for an NLRB election.
La elección fue el pasado 8 de enero y gracias a Dios ganamos.
The election happened last Tuesday, January 8th, and thank God we won.
Este fue un proceso duro porque la compañía hizo una fuerte campaña anti-unión para tratar de intimidarnos.
This was a hard process because the company ran a strong anti-union campaign to try to scare and intimidate us.
Y sus primeras tácticas fueron mandar a 5 personas de la corporación para hablarnos uno a uno y convencernos de votar no por la unión.
One of their first tactics was to send 5 people from corporate Marriott to talk to us one by one to convince us to vote no for the union.
Ellos me dijeron que no votara por la unión porque las uniones no son buenas y que iba a lamentarme haberme puesto en ese hoyo.
They told me to vote no for the union because unions are not good and that I was going to regret to have put myself in that abyss.
Ellos me dijeron que la unión me iba a robar mi dinero porque iba a pagar mucho en cuotas de unión.
They told me the union was going to steal my money because we were going to be forced to pay union dues.
El comportamiento de estas personas me hacían sentir estresadas y ansiosas porque podían llegar en cualquier momento mientras yo estaba trabajando, limpiando cuartos.
The behavior from those people made me feel stressed and anxious because they would show up at any time while I was trying to work to clean rooms.
Esta gente de la corporación iba a nuestras reuniones matutinas y nos decían que la unión no nos iba a obligar a tener señoría y íbamos a tener horas de trabajo, no íbamos a tener horas de trabajo por esto.
The people from corporate would go to our morning lineups and would tell us the union was going to force us to have seniority and we were going to lose work hours because of this.
Me sentí intimidada al ver 5 o 6 personas de la corporación en los line-ups cada mañana porque nos hablaban hasta 50 minutos cada mañana.
It was very intimidating to my coworkers and I to see 5 or 6 people from corporate every morning for an hour.
Ellos decían que no era una reunión mandatoria, pero mi manager nos miraba de manera intimidante para que no nos fuéramos.
They told us it wasn't a mandatory meeting, but we knew it was.
Mi compañera Lily se iba a salir de una junta, pero mi manager Ana le dijo que se quedara.
My coworker Liliana wanted to leave one of the meetings, but her manager forced her to stay.
Yo sabía que esto no era correcto, pero no dije nada porque tenía miedo.
I knew that wasn't right, but I didn't say anything because the company had scared me.
En una ocasión, David Marriott, vicepresidente de la corporación, vino a nuestro hotel y les dijo a mis compañeros que no votáramos por la unión porque él no quería extraños en nuestra familia.
On one occasion, David Marriott, the vice president of the corporation, which is the largest hotel company in the world, came to our hotel and told my coworkers to vote no for the union because he didn't want strangers in his family.
Él también nos dijo que no necesitábamos una unión y él así.
It's okay.
Yeah.
This was a strong and impacting statement for everyone because we had never seen anyone from such a high position tell us what to do or what he expected from us.
Candy Anderson, manager general, venía regularmente a hablarnos y a pedirnos una segunda oportunidad.
Candy Anderson, our general manager, would come every day to talk to us and ask for a second chance, third chance, fourth chance.
Ella nos pedía que apoyáramos al hotel y no la unión.
She asked us to support the hotel and not the union.
En una ocasión ella vino hacia mí y me dijo que olvidara el pasado y que fuera borrón y cuenta nueva.
On one occasion, she came up to me while I was working and told me to forget the past and start a new day with her and give her a new chance.
Yo le dije que le preguntara a mis compañeras de trabajo, tantos años aguantando tantos abusos a través del tiempo en el hotel.
I told her to ask my coworkers who have worked many years, 20, 30 years in some cases, and suffered a lot of abuses through their time at the hotel, whether they thought she deserved a second chance.
A mí me dio coraje que ella me dijera que simplemente olvidara todo lo que nos había pasado, todos los años de abuso no.
I was so angry at her for telling me to simply forget what had happened to us, all the years of abuse. This is something that I can't forget.
Es algo que nunca se olvida. Yo he venido aquí a decirles todo lo que nosotros hemos pasado en nuestra lucha para ganar la unión a través de una elección.
I've come here to tell you everything we went through in our fight to win the union through an election.
Desde el momento que nosotros archivamos la elección, la compañía hizo de todo menos ser neutral.
Since the moment we filed for an election, the company has been anything but neutral.
Yo quiero que mis hermanos y hermanas del Hotel Pullman no tengan que pasar por la misma terrible campaña que nosotros.
I don't want my brothers and sisters at the Pullman
Thank you,
Hotel,
Ms. De La
which is
Rosa. We
also
appreciate
owned
your
by
being here.
CBRE,
Mr. Fine?
to have to
Mr.
go through
Fine.
the same terrible
Ma'am,
campaign
would you
that
please
we
ask
went
Mr.
through.
Fine to
Please
cease
tell
and desist?
CBRE that this is not acceptable.
Mr. Fine, your time is up. Ms. De La Rosa, may I address you, please, ma'am? We appreciate your being here. Your story may well be a valid story, and you may well be abused, and there may well be a problem here, but we're not a body that adjudicates labor disputes. For us to adjudicate your labor dispute and come to some judgment as to who's right and who's wrong would require an expensive, time-consuming investigation. We can't do that. I hope you understand. It's no reflection on the merits of what you're saying or you. Your work is appreciated, but we're not in a position to judge the dispute. Fortunately, there are bodies available that do adjudicate labor disputes, and you have access to those, and we would really appreciate your taking this matter to them. And if there is an adjudication that you'd like to bring back to us, I'm sure we would consider it. Thank you very much. Thank you, Mr. Fine.
I'll make my comment now.
You had 6 minutes.
6 minutes with translation for her statement, and then
All
3
right,
minutes
Mr.
for
Fine,
my
in
statement.
light of my comments, do you really want to continue?
Yes.
Please go ahead. This is, by the way, this is a very expensive public expense, and there are better fora for you to present your case. I'm not saying you can't.
Good
do it.
morning. As
Mr.
you've
Hoyt,
heard
I'd
from
like to object to
Araceli,
that.
CBRE has misled you.
You're fine. If you would stop for a minute, I'm going to recognize Mr. Priovalos before you speak.
Mr. Hoy, I'm objecting to it. Each speaker has had 3 minutes. There was a total of 6 minutes given, and I object to any further testimony on this issue. We've got business to take care of today.
Thank you, Mr.
In the
Priovalos.
board
However, excuse me, I'm going to rule on Mr. Priovalos' objection first. My understanding of the law, the Brown Act, and I've been so advised by Mr. Tran this morning, is that when there is a translator necessary, and I don't know that Ms. De La Rosa needs a translator or not, but I'm presuming that she does, that the speaker is entitled to double time. Therefore, she was entitled to the 6 minutes, and Mr. Fine is entitled to the 3 minutes. And I'm not hostile to what they're saying. I'm just hostile to the process of taking up our time to do it when we can't investigate the matter. Go ahead, Mr. Fine.
Thank you. As you've heard from Araceli, your investment manager, CBRE, has misled you. Furthermore, they've put the money that you've been entrusted to manage at unnecessary risk by allowing labor disputes to progress at 2 hotels that it's seeking to sell. I provided the board with suggested language with a letter from the Irvine Marriott's general manager which stated in part, please vote no when you cast your ballot in the election on January 8th, 2019. The hotel has been accused of seven separate violations of the National Labor Relations Act, which is the regional office of the National Labor Relations Board, and they are currently being investigated. This is the opposite of neutrality. Despite the hotel's aggressive anti-union campaign, workers voted overwhelmingly to join Local 11 on January 8th. Pullman San Francisco Bay Hotel Management has also refused to stay neutral in response to worker organizing. After Pullman workers started picketing, the hotel brought in regional management to hold departmental meetings where employees were told that they could lose hours because of their actions and that workers didn't need a union to represent them. Furthermore, management has called law enforcement during picket lines to intimidate workers exercising their federally protected right to organize. In addition, the hotel deducted time from workers' paychecks after workers went to talk to the general manager about union organizing. 3 wage and hour claims filed in response to this retaliatory conduct are currently pending with the California Labor Commissioner. The Irvine Marriott's and Pullman's anti-union activity comes as CBRE is marketing the hotels for sale. In fact, the general manager of the Pullman Hotel said that of the 60 companies that were invited to tour the Pullman, only 6 bid on the hotel, and all of their bids fell through. Quite frankly, we're not surprised. This is a fiduciary issue for your fund. It is well within the purview of your fund to take action. And quite frankly, I take issue with your intimidation of Araceli, who has taken time from her family to come talk to you today. I've provided the board with a suggested letter to CBRE expressing concern with the firm's inability to mitigate risks associated with labor disputes at the Irvine Marriott and Pullman San Francisco Bay hotels, and indicating that this issue could factor into the fund's decision to invest or not invest in future CBRE funds, as it well should. Sending this letter would cost you nothing. It would demonstrate to CBRE that you care about the risks posed by this dispute, that you care about your beneficiaries, and that you want to resolve the dispute to clear the way for a profitable sale of the hotels and return capital to your beneficiaries. Thank you for all the time that is provided by the Brown Act.
Mr. Fine, thank you. I appreciate your comments. I'm not casting a judgment on what you're doing. I'm just saying that this isn't the time or the place for it in our view. And if staff comes back to us and makes a recommendation, then we'll act on that. But the board is not educated or equipped to adjudicate it. What I do wish is for both sides to reach a labor peace and do the right thing. That's all we can say. Thank you.
It isn't all you can say. The board has a fiduciary responsibility to direct staff to manage the risk of their funds, to direct staff, not to wait for staff.
All right. Thank you very much, ma'am. Thank you, sir. All right. Those are the only speaker slips I have on public comment. Unless someone else would like to speak, let's move on to approval of consent agenda items. All right. So Charlie made the motion, but because it comes out of,
No, it's good.
it's okay. All right.
Ready to vote?
We're still waiting for somebody to vote, maybe.
Carol's in. All votes are in.
All right. That passes. Consent agenda items A through D have passed unanimously. That brings us to consideration of action items pulled from the consent agenda, of which there are none. Next is the business operations section, and the action items here, 1 through 5. First one is the asset liability review, and I would ask Steve Voss and Phil Kravakis to come up and make the presentation.
Good morning, everyone. Good to be here. Last time we were here in November, we gave a brief outline of the asset liability process and just wanted to give you an update as to what we've been doing since then. There's been a variety of discussions that we've had with your executive office. We've worked very closely with your actuary, Chiron, Gene and Alice. And we're here today to present the outcome of the asset liability study. It's a pretty lengthy deck, and there's a lot of dense material in there. We will try to walk you through that and answer any questions that come to mind. Please do ask questions. We want to make sure that we use your time wisely. You were very engaged in the last discussion that we had, and hopefully you'll be as engaged this time around. Just by way of reminder, we do this every 3 years. So the last time we did this was 2016. The outcome of this will help inform you and all of us as to what the mix of your assets should be between return seeking and risk reducing. As a reminder, that current mix is 78% return seeking and 22% risk reducing. Following this, the meeting in March will talk about your asset allocation, which is the natural next outcome of the process for where we are today. So looking for your guidance, your feedback, and a good discussion. Phil's going to walk us through much of the presentation, and I'll chime in with some comments and questions to make sure that we're hitting the right points. So with that, let's go ahead and dive into the first slide, and I'll turn it over to Phil.
Fantastic. Thanks, Steve. Hi, everyone. All right. So the purpose of this discussion is to review the results of the analysis and to glean insight into the investment strategy for the pension funds. Now, before we dive into the numbers, perhaps just to cover what's in the materials, I'm going to start with an executive summary, really the bottom line on top. So I'll talk about what we see as a result of the analysis. Then I'm going to dive into a little bit of the analysis, and I'm going to keep it fairly high level, but really 3 facets of analysis: portfolio analysis, asset liability projection analysis, and an analysis of the fund's liquidity. Those are the 3 key facets of the analytics that we performed. And then we'll wrap with summary conclusions from there. And happy to take questions. Feel free to ask questions as they arise. All right. With that, page 4 is really the starting point of the analysis that we performed. These are the asset liability profiles as of June 30 of 2017. Now you can see we've summarized the characteristics of the City of San Diego plan, the Unified Port District plan, the Airport Authority plan, and the total. I'm going to focus on the total for just a moment. You can see the total shows $7.58 billion of assets with $10.288 billion of liabilities, 73.7% funded in total on that basis. And you can see the individual plans and how they compare to the total. The City of San Diego is the lion's share of the total, 73.2% funded in that plan. You can see just below that, return-seeking assets, Steve just mentioned, 78% what we call return-seeking assets. Those are growth assets, things like equities, stocks, and 22% allocated to risk-reducing assets, those being things like investment-grade fixed income. Just below that, you can see a hurdle rate analysis. Now, for starters, we know that the liability is growing at 7.92% per year. Let's call it just shy of 8% per year. Now, if the liabilities are growing at 7.92% per year, but the plan's underfunded, that means the assets have to grow faster just to keep pace with the liabilities growth, faster as a percentage. And so you can see the asset hurdle rate is 10.75%. That's effectively, you can do the math. It's 7.92% divided by 73.7%. Gets you to the 10.75% asset hurdle rate. Now, the assets can grow one of 2 ways. They can grow with investment performance or funding or some combination thereof. And the question becomes, well, how much of the 10.75 asset hurdle rate would you like to come from investment performance? And that might help guide you as far as the risk level in the portfolio. Now, the good news is this. The expected asset growth is 12.29%. In other words, we're expecting the assets to grow faster than the hurdle rate, which is fantastic news. That'll help the plan play catch-up over the course of the next 15 to 20 years. And so while we see a 73.7% funded ratio today, we expect over the next 15 to 20 years to move towards and through 100% funded. And so I'll describe that in more detail as we work through the document. So while today the picture is an underfunded plan, the prospects over the next 15 to 20 years are bright for the plan as we see it in the expected case. Questions here? This represents the starting point of the analysis.
I'm very curious to hear about how you can project 12.31% asset growth rate.
So I should have articulated that a little bit. 12.29% asset growth is a summation of two components. It's a sum of the expected investment performance plus funding into the plan. And so when you combine the contributions going in plus the investment performance of the fund, we get to the 12.29. And just to put a bit more specificity on that, I think we're projecting investment performance of 6.9% or so, with the remainder coming from funding.
Thank you.
Thank you.
That assumes current funding policy with no change.
Correct. All right, so continuing on. So page 5 is the summary conclusions. I mentioned we've gleaned some reactions from our analysis. And before we do the deep dive, just some high-level observations as we see them. Again, I alluded to the three key facets of our analysis: portfolio analysis, asset liability projection analysis, and our liquidity analysis. And as far as the portfolio analysis goes, we think the current portfolio is well constructed and well diversified. So as it sits today, according to our capital market assumptions, our latest and greatest capital market assumptions, the current portfolio is expected to return 6.91% per year over the long run. And that exceeds the actuarial assumed rate of return, 6.75% for fiscal 17 and 6.5% for fiscal 18 and beyond. Now, as we'll see, we've analyzed varying degrees of portfolio makeup, varying degrees of return seeking versus risk reducing, and we'll compare and contrast the characteristics of those different portfolios on the projected financials of the pension plan as we go through the material. Moving on to the asset liability projection analysis, we see that this is a long-term projection, a 20-year projection. So you'll see that the longer the time horizon, the more propensity you have to tolerate risk. And I'll describe why I say that as we work through the materials today. The good news is this: the funded ratios are projected to move from today's 73% to north of 100% over the next 20 years. Now, that's in the expected case. And you'd be taking risk to get there, right? 78% return-seeking portfolios it's today. So you'd be taking risk to get there. It's not a certainty. However, we believe that it's likely. And when I say we believe it's likely, according to our analysis, we believe you have a 55% chance of getting to 100% plus funded ratio over the course of the next 20 years. So certainly not a certainty. However, there is an expectation that will move to 100 plus over time.
So I had a quick question. The 6.91%, that's expected to go out 20 years plus or whatever. Is that assuming the same asset allocation set that we have now? No changes. So
Yes.
Because of the nature of the closed-end fund, at some point in the future, we may be looking to de-risk, probably within the next 20 years, maybe within the next 10. So that would change the asset allocation structure of the fund and reduce the 6.91% most likely. So how do you take into consideration the de-risking possibility out in the future?
Yeah. So we have analyzed not just the existing portfolio. The baseline is the existing portfolio, but we also analyzed other portfolios, so you can compare and contrast the characteristics of today's portfolio to what might potentially be tomorrow's less risky portfolios. And so we'll present those for your review as we work through today's discussion.
Great question and great answer.
This is also why we do these every 3 years, that we recognize circumstances and situations change, so we want to revisit your facts and circumstances in the capital markets as well.
All right. Okay, so the last point on the page has to do with our liquidity analysis. Now, we recognize that the pattern of funding into the program is going to be front-end loaded. So let's say over the next 15 or so years, we're expecting higher contributions. And as the funded ratio works towards 100%, less funding towards the back end of the projection analysis. And so what we did was performed liquidity analysis to examine whether the nature of the fund and the liquidity of the fund remains sufficient over the course of time. The good news is we believe it is sufficiently liquid over the course of time. However, there are some stresses that we'll examine, and in some of those stress scenarios, there's a little bit of stress put on the assets. However, nothing that would be onerous in our view, nothing that would require fundamental wholesale overhaul of the existing program. All right, so with that, so that's really it. And by the way, the bottom line on top, everything that we're going to talk about comes back to the points on this slide. Okay, so the message is all shown here. Now the remainder of the discussion will be to substantiate the message that I just shared. Before we dive into some of the detail, any additional questions? Great questions so far. Okay, all right. Okay, so let's dive into the analysis. Now, this is just for discussion. We study the City of San Diego plan, the City of San Diego plan being the lion's share of the total. Here you can see some of the history. The blue line represents the growth of the liability over time. The green line represents the growth of the assets over time. And you can see the investment performance has been up and down depending on the year that we're looking at. The goal will be over the next 15 to 20 years to have the green line play catch up to that blue line. Right? So that's the goal. That's what's ahead of us. And so everything we're doing is helping that green line play catch up to the blue line over time. That being assets catch up to the liabilities.
Can we go back to that slide for 1 second? I had a question. There's an increase in the steepness of the blue line toward the far right end. Is that the change in actuarial assumptions that occurred 2 years ago?
Yes.
Okay.
All right, so a bit more specificity now when it comes to the plan. You can see upper left-hand corner of the slide. Market value of assets, $7 billion, almost on the nose. Actuarial liability, $9.565 billion. 73.2% funded on this basis. This is a snapshot as of June 30th, 2017. You can see the target asset allocation in the bottom right-hand corner. This is why we're saying 78% return seeking, 22% risk reducing. You can see the nature of the portfolio and its makeup. It's a well diversified 78% return seeking portfolio as we see it. And then finally, and perhaps most noteworthy on the page, are the components of the liability growth rate and the asset growth rate. And you can see the liability growth rate, 7.86% is the liability growth rate. And that's effectively the liability is growing. So you have a $9.565 billion liability that's growing at about $750 million a year. It's growing $751 million per year because you have an interest cost or a discount cost, something on the order of $645 million. That's effectively a time value of money mechanism. Every year that passes, you have one less year of discounting in your present value calculation, and therefore your liability naturally grows with the actuarial assumed interest rate. And in this case, it was 6.75%, and we know that that's since dropped to 6.5%. But $645 million of liability growth just due to the passage of time, due to the interest rate and the present value calculation. Another $100+ million of normal cost, $106.2 million of normal cost. That's the cost of new benefits that accrue to your people each year. So as the year passes, your participants earn more service, their pension benefits grow. The present value of the sum total of the growth of pension benefits, $106.2 million. When you add the 645 to the 106, you get the $751 million of liability growth. As a percentage of the liabilities, 7.86%. So your liability is growing at 7.86% per year. But as a percentage of the assets, it's 10.74%. Okay? So we need the assets to grow 10.74% just to keep pace with the liabilities. And or more than that in order to play catch up. And the good news is this. The asset growth is expected to be 12.31% in this plan. 6.91% is due to the investment performance of the assets. Another 5.4% due to contributions.
I heard a number of 12.29 and a number of 12.31.
Those might be the difference between total versus the city of San Diego. So
Got
I
it.
was talking
Okay.
about the total.
All right.
And
Thank
here
you.
I'm talking specifically about the city of San Diego plan. Very similar numbers because the city of San Diego is the lion's share of the total.
Right.
Okay, so the good news is 12.31% exceeds 10.74%. That will help us play catch up over the course of the next 15 to 20 years. Good news, and frankly, that's not always the case. And when it's not the case, and the expected asset growth is shy of the liabilities, the hurdle rate, then the opposite is true.
But you're going to address Bill's point that when we remove risk from the portfolio, we're going to potentially have a lower growth rate. And I'm not saying it becomes negative, but we're going to find out whether it becomes negative, stays positive, that sort of thing.
Well, so, it's an interesting point. Let me address it a little bit now, and we'll address it more as we go. What happens is as the funded ratio improves, right now we have a 10.74% liability, an asset hurdle rate, 10.74%. That's because if we're 73% funded, the assets have to work hard.
George's point.
Exactly. And so what happens is, as you move to 100%, that hurdle rate will decline from 10.74% to 7.86%. Effectively, it will remove the burden. It will remove the burden of the investment performance and or funding into the program, and you'll see that play out over time. So effectively, as the hurdle rate drops, so too does the necessary performance of the assets, either from funding or investments. So too does the burden removed from the asset. So we'll see how that all plays out as we go. Okay. All right. This is actually, page 9 was an illustration of exactly that point. You can see that 10.74% hurdle rate today, if you're 100% funded, that hurdle rate is substantially less. And by the way, if you were 50% funded, for example, that hurdle rate would be pronounced, right? And so you can see how the hurdles change as the funded ratio of the program changes. It's an inverse relationship. All right. So page 11 is the
I have a question about hurdle rates before we move on. Sorry.
No worries.
I guess simply put, has the hurdle rate percentage always been greater than the growth rate percentage, like as long as we've had the 78-22 allocation?
So I think your question, please correct me if I'm wrong, I think your question is, has the hurdle rate of 10.74% always exceeded the liability growth rate of 7.86%?
No, the other way. So earlier you said our asset growth rate is 12.3%, which is good because it's greater than our liability rate of 10.7%. I guess I'm asking about the history of those two percentages, and has it always
Was it ever
in our favor?
Yeah, was it ever inverted where it was going the other way?
Which will lead to my next question: is how much of that is including or is building our liability in the previous chart where you have the blue line with the liabilities versus.
Yeah. So thank you for the question. So page 7 illustrates the points in terms of actual performance. Page 8, the numbers that we're talking about here are expected on a go-forward basis.
Can you go back to page 7 for
Yes.
1 second?
Yes.
So I think Jeff's question is, did it ever go the other way where the assets were not growing as quickly as the liabilities were growing? And I think if you look at the chart, every time that green line gets further away from the blue line, that's why. And every time the green line gets closer to the blue line, that's where you're in a position where your assets are growing faster than your liabilities.
Exactly. So you can see where the green line is pointing down. The blue line is consistently pointing up. Mm-hmm. And the whole point of the
Liabilities are always getting bigger.
Who did that?
And so the point of the exercise is to ensure that the green line meets the blue line over time. And there were 2 periods where the opposite happened. So to your question, there were two periods where the green line moved in the opposite direction of the blue line, that being 2008, which was a difficult year. I think that was your fiscal 09. And also the period between 2000 and 2002, where assets headed south. And so effectively what happens in those times is you build up a shortfall, right? And then over time, and so now we have over time accumulated a shortfall. Effectively, those two periods were the biggest contributors to that shortfall. And the question now is, well, what do we do going forward? And how do we bring the green line closer to the blue line? And we project that the green line and the blue line will converge in our analysis in the expected case. However, there have been times certainly where the liability growth has exceeded the asset growth.
And we've had an unprecedented 10 years of growth in the green line. That's never happened before.
Okay. All right. So with that, I'd like to move to the beginnings of the analytics. Page 11 is the portfolio analysis that we performed. I mentioned it at the start. We like the construct of the portfolio. We think it's well constructed, well diversified. It's a 78% return-seeking portfolio. And you can see that the current portfolio lies effectively on top of the efficient frontier. You can see that the graph shows the current policy versus the efficient frontier.
For some of us, efficient frontier is not an easy term. What does that mean?
So the efficient frontier is, and by the way, you can see it in the graph, it's the curve that represents at every level of investment performance, at every level of expected return, the portfolio which minimizes the volatility or the risk. Okay, so these are the portfolios that, whether you're shooting for low growth or high growth or something in between, the portfolios that are the most efficiently constructed, the ones that have the least risk for that level of expected return. And so the ideal is to be as far north and west as possible. In this graph, you can see the vertical axis is expected return, horizontal axis is volatility or risk. You want as much return with as little risk as possible. But we know that there's going to be a trade-off between return and risk. You can capture more expected return, however, you have to accept greater risk to get there. And so the curve represents, according to our capital market assumptions, the spectrum of potential solutions, which is most efficient. In other words, captures the expected return with the least amount of risk. And you can see we've modeled low risk to high risk and everything in between. And you can see 0% return seeking to 100% return seeking plotted on our curve. 80% return seeking towards the right end, the risky end of the spectrum, which is where your current policy is, 78% return seeking. And you can see down below there's a table that summarizes the current policy and some summary statistics, return, expected volatility, Sharpe ratio, which is a measure of return per unit of risk. You want a high Sharpe ratio, as high a Sharpe ratio as possible. 0.341, in other words, for every unit of risk you're taking, you get 0.34 units of return.
Does this chart mean that if we wanted to take the least amount of risk but still achieve at least a 6.5% return equal to our discount rate, that we would go to a 60-40 or 61-39% allocation?
So it's a great question. It looks like let's say we were just targeting 6.5. That lies somewhere between 60 and 70. Call it 60, if I had to guess, maybe a 64% return-seeking, 36% risk-reducing portfolio. Interestingly, the projection analytics play that out, and you'll see some forecasting of funded ratios which show 70% return-seeking portfolio we believe will get you there over the course of the projection period, and 60% won't. So it's an interesting takeaway, and it does play into this as well. And so, yes, so if 6.5, if you were targeting 6.5 as your return target, you'd probably be somewhere between 60 and 70% over the long run. All right, so the point of this exercise is to say, okay, well, look, here's the spectrum of potential outcomes. Here's the risk-reward trade-off, right? And so where on the spectrum should we be? The good news is the portfolio, we believe, is efficiently constructed, well-diversified among return-seeking sources with a base of public equity and then other diversifiers, things like private equity and real estate, et cetera, and then a dose of risk-reducing assets as well. So we believe the portfolio is well constructed. We did some analysis on it. Page 12,
I have a question.
please.
I'm looking at the bottom of this page on the table for these allocations of the return-seeking assets, and it looks. I assume that you ran this in a Markowitz-type optimizer.
Yes.
Right. And so your optimizer, if I read this right, doesn't like U.S. equities at all. Is that correct?
Well, so we tend to. It does. But what we do is we tend to aggregate equities into one bucket. We tend to aggregate equities into globally diversified public equity, which is effectively a 50-50 mix of U.S. and non-U.S. So, for example, when you see that our portfolio shows, and let's pick the 80% return-seeking portfolio. That's the most commensurate with your current policy. That looks like a 50% global equity portfolio. Mm-hmm. That's effectively 25% U.S. equity and 25% non-U.S. equity. If you look at your existing equity allocation, that's going to be pretty darn close to that when you look at the U.S. plus the non-U.S. plus the global. Global is going to be roughly 50-50. If you take that 8, split it 4 and 4, you would get to 22-19. Pretty darn close.
And that analysis we cover in greater detail when we do the asset allocation work, which would be at the March meeting. For simplification purposes, as Phil mentioned, we just keep it at a, quote, global level, at a higher level, just to make the process a little bit easier to digest here today.
Well, there must be something about the input parameters for global equity that the optimizer likes and doesn't like about U.S. and non-U.S. It seems strange.
Well, it's roughly equivalent. So, for example, if you were to take the model and so we do that because we introduce a modeling constraint to simplify the output. But if you were to deconstruct that 50%, it would be roughly 25% U.S. and 25% non-U.S.
So if you eliminated global equity as an asset and forced it to choose between U.S. and non-U.S., it would split it equally. You think?
That's right. That's right. And the summary statistics would be practically identical.
Okay, thank you.
Bill, a quick question. How did you go about modeling the alternatives of the SDCERS portfolio in this analysis?
For these asset classes and all of them, we utilize our capital market assumptions, which are shown in the appendix. I can cite a page if you're interested. But so all of our analytics are based on the capital market assumptions, and so we have capital market assumptions for it's an economic model based starting with things like inflation, building interest rates, and fixed income returns, equity returns, and alternative returns. And so we have, all these returns simulated in over 5,000 trials. And then that is what we're showing today, that the conglomeration of all that analysis is applied to the pension fund and where we produce portfolio analytics like this.
And you think that type of mean variance optimization is appropriate for alternatives?
So
maybe speak about building block approach.
Yeah.
The baseline.
Just to make one clarifying comment, though, we actually have more than just a mean variance optimizer because our models are built with fat tails, and they're more sophisticated than 10 years ago. We used kind of your standard log normally distributed distributions with a mean variance optimizer applied to that. And now what we have is much more rigorous, much more robust, fatter tails, varying correlations depending on regimes. So lots more rigor built in. We also have built in capital market assumptions which show more volatility in some of the privately held investments, things like private equity and real estate, than might be reported. And so all that's an effort to capture the true volatility built into the classes. So we're not trying to mask the economics. In fact, what we're trying to do is uncover the true economics of the class. And so all of those things are factored in. You can see some of that play out in the capital market assumptions in the appendix.
Thank you.
Thank you.
So does that mean you have a nonlinear optimizer that has fat tails in it?
Yes.
Yeah, okay.
So the 44% there, that represents the U.S. equity, the non-U.S. equity, and the global?
Yes, although global is simply a combination of U.S. and non-U.S.
Of all of them. So just out of curiosity, what's the size of the non-U.S. market? What's the size of the U.S. market? Just to,
It's roughly 50-50.
it is 50.
It's a little bit more U.S. than non-U.S., although that changes all the time, every day, right? But it's last I saw it was something like 52 or 53% U.S. and 48, maybe 47% non-U.S., but close to 50-50.
Thanks.
All right. All right, so in the interest of time, I'm going to accelerate a little bit. But you can see page 12, we produced some analysis of not just the central expectation of performance for a variety of portfolios, but also distributions, potential distributions of performance over the long run. This is projections for the portfolio's 60% return seeking, 70% return seeking, the current policy, which is 78% return seeking, 80% and 90%. You can see the black diamond in the middle of each of these distributions represents the central expectation. And we've drawn the red line and a dotted red line, which represent the 6.5 and 6 3/4. Interestingly, you can see exactly what we were talking about just a couple minutes ago, where if you look at the red dotted line, that's the 6.5, you can see that the 60% return-seeking portfolio has a central expectation a little bit south of that. The 70% return-seeking portfolio has an expected return a little bit north of that. Okay, so that's, again, more along the lines of what we've been talking about. Now, the good news is the current policy, 78%, is above both of those metrics. However, there's risk. There's risk associated with that investment strategy. You can see that the span or the tails of the dispersion of the outcomes is wider for the current policy than it is for the 70%, and wider still than the 60%. All right. Page 13 is just an examination of the distribution of public pension funds and their return assumptions, and we've overlaid the San Diego interest rate assumption. You can see the green line represents the interest rate assumption today, 6.5%, last year 6.75, and you can see that it's been falling over the course of the last few years in accordance with other California plans.
Question there.
Please.
To get the variation of the expected returns, did you run Monte Carlo on? You ran a whole bunch of optimizer results,
Yes.
thousands of them, whatever.
Yep. 5,000.
We'll show you that on the next slide.
Okay, thank you.
All right, so that was the portfolio analysis. Now, to move to the second facet of our analytics, the asset liability projection analysis. And exactly as you alluded, Steve. So this is how we run our stochastic analytics. You can see we effectively run 5,000 different economic projections over the course of the projection period. This isn't your numbers, by the way. This is just an illustration. But to illustrate how we conduct our analysis. And you can see what a single simulation might look like, and here we're showing projected funded ratios. And then when you do that 5,000 times, you can see it gets, it gets pretty busy. But what we do is we'll then summarize those results in terms of distributions of outcomes. And you can see we'll summarize percentiles of outcomes.
Are those standard deviations or just percentiles?
Percentiles. percentiles, although they're related. For example, a 95th percentile outcome is about a 1.6 standard deviation event. You'll notice the black dotted line, that's the central expectation, or the 50th percentile, if you will. We're going to spend a lot of time examining that 50th percentile outcome because that's where you're pointing, right? That's the central expectation of where you're headed. We'll study that first, and then we'll examine the tails around it. And there will be some questions that you'll need to consider over time, today and over time, which is, well, where are we pointing, and how much risk are we taking to point there? Okay, so ultimately, that'll be the question at hand. So this is how we do it. Now, to start talking about the projection analytics, here you can see the same portfolios that we studied with the portfolio analytics we studied with the stochastic projection analysis, the asset liability projection analysis. You can see 5 portfolios studied across the slide, 60% return seeking, 70% return seeking, the current policy, which is 78% return seeking, 80% and 90% return seeking. And here we're looking on the page, we're looking at the projected funded ratios over the next 20 years. I'm going to start with the current policy. You can see that the current policy has, it starts life with funding in the mid-70s, and that's about 73%. And you can see what happens over the course of time. It's projected to move north of 100% with the black dotted line. That's the central expectation, right? That we're expecting that the current policy will move north of 100% over the next 20 years. Now that should be that's what you've seen before. That should be what you're expecting to see. But there is risk. There's risk in that we see that you move north of 100% 55% of the time. However, there is risk. There's a 45% chance that you don't hit 100 at the end of the 20-year period. And you can see in the worst case scenario, which is the dark blue line, you can see that very quickly you could fall below 60%. Right? In the next 2 or 3 years, you could find yourselves below 60% funded. And in the best of times, which is the dark green line, you could find yourself north of 100 in the next 2 to 3 years. Right? So there's considerable risk in the portfolio strategy that you've selected. However, the central case shows that moving north of 100, and if you examine the 25th to 75th percentiles, that's called the interquartile range. Examine that. There's a 50-50 shot over the next 20 years that you'll lie between the light blue and the light green. In other words, 50-50 shot that you'll lie between roughly 80% funded and 160% funded over the next 20 years. Over the next 10 years, you have a 50-50 shot of being somewhere between 70% and 110%. Okay, so it's a coin flip. That you will probably be somewhere between 70 and 110 over the next 10 years. So it's not certain, right? There's uncertainty here. However, things are pointing in the right direction. Now, also interestingly, compare the current policy to the 70% return-seeking portfolio. 70% also hits 100 in the expected case. There's less risk. The downside is a bit less pronounced than it is with the current policy. But you're expected to get to the 100% funded over the course of the 20-year period. But move left further still to the 60% return-seeking portfolio, it never gets to 100 in the expected case. Okay, so if you were to select the 60% return-seeking portfolio, what would likely happen is additional funding would be required to get to that 100% level. Okay, and then on the flip side, you can see that taking more risk gets you to 100 faster, albeit with more risk, more uncertainty. Questions here? This is an important one. All right. We did some further analysis on the likelihoods of eclipsing these various thresholds, likelihoods of eclipsing various funded status thresholds after 5 years, 10 years, and 20 years. So interestingly, if you look at the current policy, you have a 14.8% chance of hitting 100% over the next 5 years. So probably not, but some shot. You have roughly a 50-50 shot of getting to 80 after 5 years, with the current policy. After 10 years, you have a 35.6% chance of getting to 100 with the current policy. And after 20 years, a 54.1% chance of getting to 100 with the current policy. Okay, we've studied all the portfolios that we've been talking about. And in green, by the way, is the percentages north of 50. So in other words, if it's likely, we put it in green.
So Phil, on the right-hand side, the 70-30 portfolio is in green. So, and I guess referring back to the previous chart, I hear you saying that we will meet our objectives, this is oversimplification, but meet our objectives with less risk with a 70-30 portfolio.
Yes, they both have a greater than 50% chance of getting to 100. So they're both expected to get to 100. Just examining, they're both they both seem to be fine solutions as far as I can tell. If we look at page 16, you can see the current policy gets there a little bit faster with a little bit more risk. The 70 gets there a little bit slower with a little bit less risk. Both seem reasonable solutions. Okay, moving on, contribution forecasting. The same type of thing that we've been studying, the same type of display. Again, the 60 through 90% return-seeking portfolios across the top of the page. You can see the current policy in the middle with an expected contribution that's fairly flat, 400 million or so. And by the way, this is employer plus employee. 400 million or so before it trails off, and this should be no surprise, right? It's expected to trail off as you get closer to 100 as those amortizations fall off over time. So roughly 400 million of contributions are expected to go in the expected case. However, there's some range of potential outcomes for those contributions. You can see the contributions could go as low as 100 million, effectively bottoming out at the employee contributions, and could go as high as 800 million over the next 10 years or so, if in the worst of times, if you will. And so there's quite a range of potential outcomes here. And you can see what happens if you move to the left. The black dotted line is ticked up ever so slightly to move from the current to the 70. What is that telling me? It's telling me that we're expecting ever so slightly more contributions to move from 78 to 70 in the expected case. And that's particularly true at the tail end, where you start getting into your steady state. Right? At your steady state, you're 100% funded. You can choose a 78% return-seeking portfolio or a 70% return-seeking portfolio. The 70% will return less, which means you'll have to pay more. And then further still, if you move further to the left, again, you can see that black line dragged ever so slightly higher. So you can see there's an implication to taking risk off the table over the long run, and you can see what it means in terms of contributions going into the plan. And effectively, the story is, if you're not getting those returns from the market, you'll have to fund those with cash. That's right. And if you're getting those returns from the market, you're taking risk to achieve those. And so you have to be aware of that as we go.
So I had a question. So one of the options we're looking at today in terms of a vote is a floor where we would fix the contributions so that they would never go below the floor. How would that work here if we had that?
So we studied that also. It's not in this presentation. However, we studied that as well. The results are similar, although, as you might expect, if you had a floor, you'd see the floor come in at around 300 million, which is around the current level. I think it's 275. But you'd see a floor come in, and effectively what that would do is it would take, it wouldn't, the central case would be effectively where it is now, but the downside in this case, which is a good, the downside on contributions is in positive economic scenarios. But the downside on contributions would have a floor effectively truncated at 275-ish million. And if you were to look back at the funded ratio projections, they would tick up ever so slightly. But very similar results, not terribly different results. And that's because the the contributions are expected to move sideways, if you will. In other words, to be fairly consistent with where you are today. And so the floor doesn't really come into play unless you have a good market scenario where the funded ratio is improving. In other words, the central case is not impacted.
So what you're saying is if we voted for the floor, it's not going to change these assumptions that much.
No, it would be fairly immaterial to the results over time. What it would do is it would truncate the bottom end of the numbers on this slide.
Would that also, if we were to vote for the floor, provides the city with a known number, at least, that they would have to achieve, which would be good. They'd have a known number. However, it also might provide a glide path or a smoothing out rather than a cliff in terms of the getting to 100% funded?
There would be a little bit of a smoothing out pattern there. However, I'm looking at the picture. The pictures are very similar. So it's the difference is ultimately minimal. So it's not an onerous solution to move to the floor. Okay. All right. Again, interest of time, I'll keep going. Page 19 shows our net outflow analysis, which effectively says, what is the difference between benefit payments out and contributions in, and are there net inflows or outflows into the plan? To the extent there are large net outflows, that could pose a risk to the liquidity of the fund. Here we find that, again, I'm looking at the black dotted line of the current policy, that the net outflows range from effectively 2 to 4%, just north of 4% in some cases. You will see that it ticks up 10, 15 years out. And that's important. So that seems to be the most dangerous liquidity zone, if you will. And so we took a close look at that in our liquidity analytics to examine whether there was particular stress in years 10 through 20. We found ultimately there wasn't, but I'll show you the results of that analysis as we go. Okay. All right. And then finally, economic analysis, 2, 10, and 20-year horizons. Economic cost is effectively defined as the cost to fully fund the program over the projection period. What is the cost to fully fund the program over the next 2 years, 10 years, and 20 years? And we examined, the range of potential portfolio solutions over the course of our projection period. Now, you can see on the graph we show the vertical axis is the expected economic cost, and on the horizontal axis is the economic risk. And here we're defining those as the 50th percentile of economic cost versus the 95th percentile of economic cost. Again, the ideal is to be in the northwest corner. You want as much reward and as little risk as possible, and we're defining reward as lower cost. Interestingly, if we look at a 2-year period, we see that the 60 through 90% return-seeking portfolios, those are fairly horizontal. If you look at the progression of dots, what is that telling us? It's telling us that the shorter the time horizon, the more horizontal the dots are. In other words, you're getting risk without necessarily getting reward. Look what happens when you move to 10 years and even 20 years. What happens? The curve moves from horizontal to vertical. What is that telling us? It's telling us that the longer the time horizon, the more reward you're getting per unit of risk. And so, said differently, the longer the time horizon, the more you're rewarded for taking risk. And the shorter the time horizon, the less you're rewarded for taking risk. And that's important, right? If you're investing for a day, you're probably just sticking that money in the bank. If you're investing for 100 years, you're probably putting a good chunk of that into risky assets. And so this helps guide in terms of, well, where should we be on that risk spectrum that we evaluated, right? If you have a longer-term proposition, generally speaking, you're rewarded for taking risk.
But wouldn't you say that with the closed-end fund nature that you don't want to take that risk out there that far out. You're going to be de-risking at some point.
So that's exactly where I was going next, which is to say, most public funds have decided, okay, it's a long-term proposition, and therefore they're rewarded for taking risk. Relative to most public funds, you have a bit of a shorter time horizon than most. So it's important for you to keep that in mind as you're comparing yourselves to others. Just keep that in mind. Now, I will say this: you have a longer tail on this obligation than you might initially think, given that it's closing soon. Because even when the plan closes, there's still a several decade tail to the obligation, right? This is still a long-term proposition. However, if you're comparing yourself to the average public pension fund, know that your horizon's a little shorter than theirs, on average. All right, and then finally, a massive number of tables that only an actuary could love on page 21 that shows economic costs, contributions, and funded ratios for all the policies that we studied, ranging from 0% return seeking to 100% return seeking, everything in between, and comparing the current policy. You'll notice it is interesting, right? If you're looking at the funded ratios, it is interesting to see the crossover point to 100 lies somewhere between 60 and 70% return seeking. So in other words, that's probably in the long run, the point where you take notice of where you're moving north of 100, knowing that the current policy gets to 107 over the course of time with downside of 50%. All right, so that was the asset liability projection analysis. The third facet that I mentioned was the liquidity analysis, and I recognize we've taken a lot of your time already. I'm just going to focus on some of the key outcomes of our liquidity analysis, and perhaps as questions arise, we can take those. We studied the portfolio makeup in 3 different key scenarios: the base case, a recessionary case, and a black skies, kind of a worst case outcome. What happens to the makeup of the portfolio in those 3 cases over the next 10 years? Do the worst of times really stress the asset makeup? And what we found was, in the base case, as you'd expect, things are kind of moving along as expected. The left side of the page shows asset dollars. The right side of the page shows asset allocation percentages. And in the base case, smooth sailing. Your assets are rising over time, and the various components of your asset base are shown in different shadings. The risk-reducing assets are in gray. The liquid return-seeking assets, things like publicly traded equities, are in light blue. And then some of the lesser liquid items are towards the bottom of the page in progressively less and less liquid vehicles. Things like real estate, in the orange. Things like private equity in the blue. Okay, the less and less liquid as we go down. Interestingly, if you project those assets out in the expected case, everything is rosy, kind of moving as it's expected. Things progress fairly normally. You can see that the asset allocation is fairly static. Over time, it doesn't really change over the next 10 years. That's in the base case. Kind of everything as expected. In a recessionary scenario, however, you can see that the asset values dip. And you can see what happens, over the course of time. There's a recovery. You can see what happens on the right side of the page. The asset allocation percentages blip up for the illiquids. Nothing that can't be managed, but nonetheless, they blip up. In the black skies, by the way, the black skies is a 99th percentile event. So there's a 1% chance of this happening or worse. A more pronounced asset drop. And you can see in the 99th percentile, the asset allocation blips up a little bit more. Okay. What is that telling us? It's telling us that the asset allocation moves, but it doesn't move such that it can't be managed. And I've seen...
By managed, you mean we would still have sufficient liquidity to meet our cash obligations?
Yes. And, in the case of a black skies event, you could manage the pace of your illiquid investments such that you could moderate those allocations back to normal. We have seen with some of our clients, the asset allocation in the bottom right-hand corner totally swamped by illiquids. We've seen, you could imagine a page that shows in years 5 through 10, all orange, or all orange and blue, dark blue. So it's problematic in some cases. This is not that case. Okay? Now, this analysis was years 1 through 10. We recognize that in your case, you have a very specific focus on years 10 through 20, as we just saw. So we ran the analysis, again, that black skies analysis on years 10 through 20. We called it the delayed black skies. And in this case, the same thing, a little bit worse than what we saw on the previous page. And this is kind of the worst case, right? Where you have the event where funding stops because you're fully funded, right? So you have less contributions going in, and a black skies event happening at the same time, right? So an economic event happening at the worst possible time for the plan. And even in that case, the asset allocation becomes a little bit more stressed, but still manageable. In other words, it's not nearly swamped. Rather, it's still sufficient and operating. And again, recall, this is a 1% chance of this black skies type event.
And so if we're not getting contributions at this point, or they're less, what is our negative cash flow? I mean, in terms of the numbers on this chart, as a, say, a percent, what would the negative cash flow be then?
So I don't have that exactly offhand. However, I can point to this. Going back to our stochastic analytics, I can tell you that the worst of the worst in terms of net outflows was a net outflow of 7%.
Okay.
And this is a 95th percentile outcome. The 99th percentile outcome would probably be a little bit north of that.
Okay.
In that scenario, in that black skies scenario, it seems to me that a future board might be hesitant to sell equities in that kind of an environment to generate cash, because that's going to put you further into the hole coming out. So does the future board then have the option of doing something else? In other words, is there enough blue in that chart that you don't have to? Because when you talked about making adjustments, my thought process is, well, by making adjustments, you're talking about selling equities. But you're selling equities into a black sky market if you're doing that, and that may be something that a board isn't going to want to do. So could you just address that?
Yeah, I think it's a fair question, right? That in the worst of times, and by the way, I mean something like that happened in 2008. Are you a forced seller of equities at that point? At that time, you'd want to consider the asset allocation target that you're shooting for, recognizing, let's say, for example, you have a large private equity allocation, and you have a public equity allocation. You're trying to rebalance to target. You might find that the mix of private equity versus public equity is a little out of whack, but you still have equity exposure, right? You just have it in the private markets, and you don't want to take the haircut in the privates, so you take a haircut in the publics, or you sell out of the publics because there's no haircut, right? So that's how it would work. Now,
but you're assuming that there's some asset allocation, there's some class of assets that's sufficiently doing better, I guess. You use whatever's up.
Relatively less worse.
Yeah, relatively less worse.
Yeah, that's right. It's not an ideal scenario, right? I mean, there's no solution to the risk that a black sky scenario poses. You have to be comfortable taking that risk and knowing that it'll happen at some point. You'll get these negative outcomes and positive outcomes over time, and you have to be comfortable with the risk that you're taking on the downside because of the benefit you're getting on the upside, or the benefit you're getting in terms of the central expectation. One of the outcomes of taking risk is this. And so then the question is, can you live with it? The answer here, as I see it, is the plan can manage. It can manage through it. It's not ideal, right? Nobody would pick this, but the plan can manage through it.
So I had just a follow-on question as well. In that black sky scenario, then, are you saying that as modeled, we would be kind of at the low end of the equity allocation, but still within investment policy compliance if you had to sell from equity?
This is more looking at the actual allocations, not really an examination of the
You didn't overlay the
ranges.
policy over this.
In terms of the target, we used the target. We didn't use the allowable plus or minus range for this analysis. I think it's a fair question. All right. And so, the conclusions as we've been discussing, right, that we see sufficient liquidity. By the way, one thing I did want to note. What liquidity is? It's a fair point, right? It's a fair concern regarding the makeup of the liquidity profile of the fund. What is the type of plan which is most susceptible to liquidity risk? The type of plan that's most susceptible, the one that's swamped by the oranges and dark blues, right, that I mentioned earlier, those types of plans have low funded ratios, have high degrees of illiquid investments, and have low contributions coming in. And I'll give you an example. We work with another client that had a 50% funded ratio that was contributing half of the ARC, the actuarially required contribution, and had a heavy dose of illiquid investments. And they were one of the clients that showed, on the back end, that the portfolio was getting swamped. In that delayed black, or not in the black sky scenario for them, it became something that wasn't easily managed. This isn't that scenario. You show there's a bit of stress here, as you'd expect. You'd expect some stress in a black skies environment, but it's still manageable. Your funded ratio of 73 moving up to 100 isn't really that kind of profile of the liquidity challenged fund. Okay. All right, so back to the summary and conclusions on page 31, which is a restatement of the items that I mentioned earlier in terms of the three facets of our analytics: portfolio analysis, asset liability projection analysis, liquidity analysis. In terms of the portfolio analysis, for the reasons we've been describing, we think the portfolio is well constructed, well diversified. Expected return 6.91%, which exceeds the actuarial assumed interest rate of 6.5%. In terms of the projection analysis, you still have a long time horizon, and long time horizons tend to reward taking risk, albeit perhaps shorter than the average public pension plan. But we're expecting that your funded ratios are going to trend towards 100 and north of 100 over time. And then finally, when it comes to liquidity analytics, we see that the fund, we believe, has sufficient liquidity. There are times of stress that we've modeled, but even in those times of stress, while the asset allocations move, they don't move to such a point that they become unmanageable. With that, I'll pause for additional questions, comments.
I had just going back to slide number 11. I guess it's more technical, but on the 44%, the global equity, in the red line, 70% return. So I assume that U.S. equities, non-U.S. equities, and global, three classes, all have different return characteristics. And in total, they're a big chunk of our fund. True, but how did you figure the return on that, lumping everything into global? So I do two things, I guess. One is, what's the correlation of those three categories? And two is, they have different returns. How did you calculate that in when you lumped everything into global? Because it's such a big part of our portfolio from a forecasting point of view.
Yes.
So we're looking up the cap market assumptions that are pretty deep into the appendix.
Right, I just wanted to find that page. So we have an answer to your question. I just want to find it.
And again, just a reminder, the reason that we did this is just simplification for our discussion purposes today. When we do your asset allocation review, at the March meeting, we get much more specific and look at the risk-return characteristics of U.S. stocks, non-U.S. stocks, and the totality combination of the two global stocks. What slide? 63?
Slide 63. All right, so we have assumptions for U.S. equity, and that's the first row. The expected return 6.5%. Global equity 7.5%. International equity 7.5%. Emerging markets equity 8.3%. There are also volatilities and on the following page correlations for a massive a table of correlations. And when we combine all of the classes, combining their expected returns, combining their volatilities, combining their correlations, a 50-50 U.S. non-U.S. portfolio will have the same return properties as global.
Okay, that answers the question.
And those are returns over inflation and net of investment fees?
The first column is over inflation. The second column is gross of inflation.
Without alpha.
Correct. Without just market, no alpha.
So part of what this isn't an action item, but part of what we need today for the next discussion when we talk about asset allocation in March is a nod of sorts that the current risk level of 78.22 is acceptable, and that will allow us, give us guidance on how to model the diversification of that 78.
It's interesting because very early in your presentation, I turned to the chairperson of our investment committee and said, we need to consider whether we should be at 70.30 or 78.22. I don't.
That's a discussion for this meeting, not for the, that's
We
why
have to
we're
do that
looking at
now?
this. Yeah, that's the point. Isn't that the point of this?
That is a big part of the point of this
I think that's
discussion.
the
Then
point
we
of it.
better hear from staff.
No, I just want to jump in here. This actually is an action item that the board has to approve, and they either have to approve staying with the status quo, which is a 78-22 mix, or moving to something else.
Thank you.
Is there a staff recommendation on this?
Staff's comfortable with the current status or 70-30 mix.
Thanks a lot. I'll at this point, I'm going to turn the meeting over to Carol.
Well, again, I this is a high level, an important issue that I think everybody on the board needs to think about. Since I've been around, there's frequently been discussion about dialing down the risk. And what I see in this analysis is that we could go to, say, 70-30, and I don't feel like, as I recall, the Sharpe ratio was actually better for that analysis, and I feel like it gets, there's an incrementally poor result, but with less risk. So I think it's totally acceptable.
Incrementally lower return.
Lower return. I guess one thing I would say is that if we keep the status quo now, I feel like this analysis tells us that when we do want to dial down risk in the future, particularly if we have the floor and we're, kind of moving towards our funding target, we'll easily be able to do, lots could happen between then and now, but that's something we could reasonably do in the future. But we could do it now.
So if I understand what Carol's saying, and I think I agree with it, it would be that you're not necessarily favoring a change in investment in the allocation today, but it should be on the table for the investment committee to evaluate over the course of the next few meetings, and then come back to the board and give us some notice if we're going to propose any change.
Would
that be all right?
I don't think that's how it works.
I don't think
Sorry.
that.
Tell me.
I don't think so either.
Usually, okay, we do an asset liability study every 3 years. That's when you determine the mix, the 78-22 or something else. You don't make those decisions at some other point. You make it at during this presentation.
So that
And so it would be the next time that you would vote on this would be in 3 years. And then you reassess where we are. Do we want to make a change then or sometime in the future?
Thank you. I'm uncomfortable with making a decision today that's not going to be reevaluated for 3 years. I guess that's what I'm saying.
I have a question, Phil, actually. Historically, when we set the 78-22, I guess it was then 3 years ago, what was the funded status? How does that compare to today's funded status?
I believe it was similar. It was in the 70s, I believe, although you're testing my memory, Karina. So I believe it was similar, and I think we saw pictures that were similar and that the funded ratio was expected to move towards 100 at that time as well. Now, at that time, you might have had a slightly lower funded ratio, but it's I'm not certain
As
about
I
that.
recall, the funding ratio was similar, but it was before the assumptions changed. So we were actually, I think, at least at the time, thought we were in a better position than we are today in relationship to it. But I don't know that that's entirely accurate. But at the time, it was before all those actuarial changes. So we may have been at 71 or 70, but again, now all of a sudden we got this bump. So, yeah. I'm going to take that nod as I'm a genius. Thank you very much. I
yes,
appreciate
you're
it.
a genius.
74. It was 74.2.
Right.
Yeah.
So very similar to where it is right now.
Similar, although just as was mentioned, the actuarial assumptions hadn't been changed at that point. So what was 74 before on today's basis would have been probably south of where we are today.
Got it.
Val, can I?
Yeah.
So just so I understand from a theoretical high-level perspective, if we need to take, and I'm saying if we need to take risk on the aggressiveness of the portfolio on the equity side, as I understand it, it's better to do that earlier in the scenario so that you have time working in your favor than it is to have to do that later on. So I just want to make sure I understand it. If there's a choice between having a more aggressive risk today or having it 10 years from now, the board would be better off to do it today than to do it 10 years from now. Is that generally speaking correct?
I'd say yes, and I'd say yes because I think I mean, these are long-term propositions, right? So let's be aware of that. But if you think about the investment decision framework today versus the investment decision framework, let's say 15 years from now, and you'll have several check-in points between now and then, 5 check-in points between now and then. But what you'll see is more need for upside today, more time today, and a lower funded ratio today. What you'll see 15 years from now, knock on wood, in the expected case, is a 100% funded ratio, a shorter time horizon, and less need for growth.
I don't think you guys are projecting 100% in 15 years.
It's somewhere between 15 and 20.
I understand it's a possibility, but that's not. I don't think that's what our actuary is projecting. Is that 100% funding?
That's likely within 20 years,
It was
55%.
20 years.
20
is
years,
55%.
right? Not 15. He's making.
But,
he's saying,
but if you looked at those spiders, some of the lines are crossing it.
It was,
Absolutely,
it was
okay.
somewhere between 15
But
and
I just want to
20.
make sure there's a difference between Gene saying 20 or Karen saying 20, give or take, and we've got multiple scenarios here, right? Which potentially could be 15.
Yes.
All right.
So, Carol.
I would say that at the investment committee level, there's been an ongoing discussion about making a change in the portfolio, and specifically right now we're looking at managed futures to kind of add an additional uncorrelated asset into the portfolio to mitigate risk because we are concerned about risk going forward. So just to be clear, those are the kind of decisions we deal with. Kind of a level down from this larger issue at investment committee, and we are concerned about it. So if you want to take that as a signal from investment committee, I don't know, but I guess that's what I would share.
Well, thank you. Yeah, almost.
I just have one question. Is this analysis one of the analyses that are being proposed today to be moved into a sort of a set schedule to occur every 3 years, concurrent with all the other various analyses that we would be undertaking?
But it's already in that. We're not changing the
currently in
schedule for this. It's always been every
3 years.
3 years.
So the only question I was having was whether, as we enter into this period where de-risking is likely to happen in the next 10 years, whether, even if it doesn't happen today, should we be only considering this every 3 years? And I guess I'd look to Liza to say, or Steve, is there some disruption to the portfolio, to the policy, to the consultants' evenings, if we say, okay, we're adopting this for 3 years, but could we look at this again next year and more frequently in the future?
You want to go first? I'm happy to.
Whatever you want.
More frequently than 3 years, we wouldn't find to be a very good informative practice. It's certainly not a best practice because you'd end up chasing your tail. If there is a major disruption in your circumstances, if there's a major disruption in the capital markets, then we might want to do another asset liability study sooner than that. But that wouldn't be our recommendation without a major disruption of some sort.
When you say chasing your tail, I'm not suggesting that it should be changed every year. I guess what I'm saying is, we're now entering a period where I think we need to walk softly and look carefully as we go. So is that still chasing your tail?
Our concern would be that you would constantly change long-term policy. As Phil has mentioned, this is a long-term game. We're seeking to build a portfolio for 20 plus years. And so if a year from now we redo this study and it leads you to change the conclusions that we come to today, we would think that would be chasing your tail.
Thank you.
And I would just like to add, we could look at it earlier than 3 years. In fact, we did that when the plan was closed. We had just conducted an asset liability, I want to say like a year and a half before, and we thought, well, circumstances of the plan have changed. We think we need to look at it, just reassess where we are, because that was a big change. So if there's another major change or a major market correction where the plan is substantively different, then we would call for one earlier.
Thank you, Liza.
So,
I think.
quick.
Go ahead. Well, Bill and then Tanasi.
Oh, okay. It seems to me like when I came on the board, our funding ratio was around below 70%. But we've had this 100% increase in the equities market, and we've been 78-22. And the funding ratio is right about where it was when I came on. Actually, today, our portfolio is about $8 billion, not $8.5 billion. So if you looked at the funding ratio, as of today, it's gone down. I'm not sure where it is, but probably closer to 70% right now. So I'm concerned that we're looking at this at an unusual set of numbers that's never happened before, where you have this 10-year run-up in the equities market, and we're making decisions now based on that, which isn't a typical period of time. So I get a little nervous about the future.
Bill, are you advocating for going to the 70-30?
Well, I could definitely be a proponent of the 70-30 at this stage, because I think we've had a run-up that's been very unusual, and our numbers don't reflect where it really might be.
Thank you. I'm going to start calling speakers because we have people in the queue, and I apologize, but I did tell Tanasi he was next, and then we're going to go to Karina and then to Jeff. And I think it would be useful if board members address the question of, would you be more comfortable going to 70-30, or would you prefer to remain at 78-22? Because my idea of doing this every 3 months is apparently being shot down. Okay, Tanasi.
So I guess the first question, and I may have missed it because I do tend to nod off from time to time, but did you discuss if we move from 22% to 30%, what happens to the hurdle rate? And I may have missed that. That would be one thing I'd like to know. Second issue is that, Bill, I want to point out that while the funding rate may have gone down or stayed the same, I don't think that that accurately takes in the big picture, because during that time frame, we've reduced the discount rate, we've increased the assumption liability. There's been a whole slew of monumental changes that have happened. And if you were comparing apples to apples, I think our funding ratio would be a higher number in the 80s. So I don't know that, because I came on the board about the same time you did. So I think that we're in a far better position today at 70% funded than we were when we were kidding ourselves about being 70% funded back in whatever it was when in the dark ages.
And Marcel's actually made a presentation that I think demonstrates
that. I think that's correct. So I just want to be clear that I think we're in a better position today, regardless of what that particular number may say. I don't know that that's the end all be all. But having said that, my concern is that we started taking risk because we had to, and I really don't want to have to take risk towards the end, because I think that's fraught with all sorts of problems. So from my perspective, to answer Val's question, because I want to do what the president wants me to do, is that I think that if unless there's a compelling reason to change, I would rather stay where we are today, delay that de-risking for some period of time, because just overall it's a better process. And I will also just say, Bill, I take another issue. I'm not making the decision based on the last 10-year performance of equities. I'm looking at just in general the difference between equities and debt, and saying, no, long-term growth and appreciation, which we have to have in this plan because those lines between liability and assets are substantially divergent. The question is, we have to take risks. So the question just is, when are we taking the risk? And I'd rather do that now than later, when we have the time to insulate us if there's a problem. If I'm off base on that, please let me know. But I think my position would be we stay where we are for the time being, and for the next 3 years, that sounds good to me. I don't know.
I agree.
Thank you, Tanasi.
I'm next in the
let's go to
queue.
Karina next.
I think there's probably two decisions here on the table. One is the overall allocation to return-seeking, risk-mitigating assets. But then within return-seeking, I'm sensing that folks are getting uncomfortable with the amount of equity risk. And that's what, to Carol's point, that we're talking about adding in strategies to diverse that equity risk inside of the return-seeking allocation. So we're not talking about the overall 78-22 mix. And without a precipitous improvement in funded status, I would be, staying with the status quo. You take the de-risking moves as a reward for being better funded, and so you're going to need to see, I would think a 2 to 3% improvement in funded status. Obviously, you're changing the actuarial assumptions because you feel like that's the right thing to do, but you're acting based on the funded status as you're moving along. So I would be a proponent of staying put and looking at ways to de-risk the return-seeking portfolio through, for example, managed futures.
Jeff, you've withdrawn?
good. Yeah.
Okay. Carol?
That was well said, Karina, and I agree with what you're saying. I just wanted to mention that, again, it seems like from time to time we all say, oh my gosh, we're going to need to de-risk this portfolio in the future. We need to dial down the risk. And I believe that's connected to where our negative cash flow will be in the future, or the time when there's just going to be more outflow because of the composition of the system. And so we don't need to do it now necessarily, but I'm wondering, should we be focusing on those numbers and thinking about when is that actual date that we need to be concerned about cash flow?
Thanks, Carol. I'm next in the queue. So I tend to agree with what Karina and Carol and Tanasi have all said, which is winter is coming, but it's not here yet. In fact, I think it's going to be this summer before we get another episode of that. But I think there's another reason to go to 70-30 from 78-22 besides just the cash management issue, which is just the philosophy of pension funds. What level of risk is appropriate for pension funds. And I think there's been a shift in thinking over the decades from saying that they should be basically set at the U.S. Treasury return rate and take no risk to what we have today, which is pension funds probably take as much or more risk than private sector funds that are invested in the market for long-range returns. And that's where we are right now. And I'm not sensing that there's some movement on this board today to say we want to change the calculus of what a public pension fund risk should be. So not hearing that from board members, then I think I agree with what the prior three speakers have said, and that we maintain the status quo, but with keeping a weather eye to making an adjustment if there's any major change, as Liza has indicated and Steve has indicated, or in 3 years from now, when we're closer to the cash flow need, reevaluating it carefully. So that's my position as of now, unless anyone else changes my mind. And Bill, you're next.
Yeah, I think that it's interesting looking at the 22% portion. So we've been in this, again, very unusual period of 0% interest rates. We're around 2 or 3%, whatever. So, you know, if that were to stay and you started de-risking, getting away from the equities, you may wind up in a low interest rate situation, which would be double jeopardy, which you'd be in trouble there too. So I don't know. I'm still in favor of going 70-30, but you know, defer to the board.
There are no other speakers in the queue. What is the motion? What is the recommendation that we'll be voting to approve when this motion is made? Just a restatement of it, briefly.
If I may address the board, I would recommend that for the asset liability study, that one motion would be to remain with the current return-seeking and risk mitigating asset mix of 78% and 22%. That would be one motion. Or if you wanted to say something else, you would just change the percentages.
All right.
Acceptable.
Then we don't have a pre-written motion up. Is that right, Cynthia? Do
Just
we?
this one here.
And to keep the status quo, if that helps.
Well, but the motion is to approve the asset liability review, which is easy, and recommendation.
But there
and
isn't-
I'm not seeing, I'm seeing that.
They've given us two options.
Yeah, we have options, so I think we have to pick one and put it into the motion.
And I'm willing to make the motion that we stay with the status quo.
The one we have right here.
Right.
The current asset
Now, it may not get
allocation.
a second, but
Okay, I'll open.
All right, let's.
oh, I got a second. Thank you.
Well,
Time out, though.
Okay,
Time
we're
out.
not gonna vote on it?
Could I ask Cynthia to please type the motion, and then George can second it.
Are we going to change it from this one?
Yes.
Okay.
And just add to after recommendation, you can just add it to maintain the current asset allocation.
I think it would be to retain the current 78-22 allocation, not asset allocation.
Now you're
thank
just
you.
showing off.
All right.
That's all you're doing.
How's that?
Is that okay?
Yeah.
All right. That's the motion that Tanasi has made. Tanasi, you want to push your button, and then George is seconded.
Oh, sorry. I can
Ready to
get
vote?
back up. I wasn't seeing.
All right, seconded by Karina.
My wife says I push your buttons all the time. You want some help?
All votes are in.
All right, that carries 12-1. Mr. Hayner voted his conscience. All right. I think at this point, Steve and Phil, you've completed your presentation.
Correct.
Thank you, Phil, for an excellent presentation. Steve, thanks for being here.
Thank you.
And with that, why don't we take a short recess and come back in 10 minutes?
Thank you.
Actually, I'm Washington, D.C., she's San Diego.
And I'm
Chicago's
Solana
the average.
She's here. You're from Washington. Okay.
Chicago's a good average. Right?
All right. So with that, let's go ahead and hear from Chiron.
I believe the next item the staff will introduce.
I was wondering if I could make a couple introductory comments?
Yeah.
Oh, awesome, great. At the board retreat, we talked about actuarial methodologies and assumption changes, and the board provided direction at that time that they would like the consultants and the staff to go back and look at setting to evaluate an employer contribution floor and come back with recommendations, and that's what this item is here today. And effectively, it's a minimum employer payment, so a minimum payment, but more specifically, a minimum unfunded actuarial liability payment, so a minimum UAL payment. And you may recall that in future periods, we expect the unfunded actuarial liability payment for the employers to reduce over time. There were some prior discussions about a cliff or a smooth cliff, and this board has taken previous actions to smooth that payment over time. So the concept here with the contribution floor is really to hold the UAL payment for the employer at a constant rate in future periods should that rate be calculated to decrease. And so it's a very effective payment method when we expect to have a UAL payment decrease. And for the city plan, we expect there will be some significant decreases based on our current model 10 years out or so in 2029. And for the port, a little bit sooner than that in 2027. So this would be a amortization method change that would affect some future periods going out into the future. And really, this perspective really does a good job balancing our funding objectives that we talked about. Benefit security, it helps us move towards 100% funding a little bit sooner by effectively shortening the UAL amortization period. As mentioned earlier today, it provides stable and predictable costs, addresses intergenerational equity as these changes would happen within the active working lifetime of our current workforce, and addresses cost sustainability about continuing the 2018 UAL payments and not increasing those for impacts of inflation or other factors. So in essence, the UAL contribution floor is most effective when we can meet or exceed our actuarial assumptions, when we have actuarial gains, and would be less effective if we fail to meet those assumptions and we're addressing actuarial losses. And I'd like to note that the current amortization methods require should the current amortization methods require a greater amortization payment, the floor would not prohibit us, the board, from having greater UAL contributions from the employers. Staff believes that this is a better actual amortization approach than setting a hard date into the future, and it will help us reach our goal of 100% funding ratio in a little bit more timely fashion. Thank you.
Thank you, Greg.
So, given the previous presentation by Ann, we're going to skip slides that talk about what is stochastic testing. So, we're going to skip straight to slide 4 and get you used to the kind of charts you'll be seeing in this presentation and ones that follow. We'll be showing a series of grayish bars versus colored bars, and those are percentiles. The top of the dark green, bottom of the dark red are 90%. Top of the light green and bottom of the orange is the 50th percentile. Then there's the expected line. You saw similar, although different format charts from the previous presentation. In this case, there's no difference between the gray and the colored. And down below at the bottom, it's showing the discount rate is remaining at 6.5%. We're not lowering it. There's no floor or anything. There's no maximum contribution. So the results are as expected. If we move to the floor that Greg had mentioned, slide 5, and this is the key slide in this presentation, we're looking at the actually determined contribution, and let's focus on the dotted lines. The gray has that magenta purple color versus to the right of it, the black. So you're going to get higher contributions because you have the floor. And you see at the very bottom of the colored bars it stops at a number somewhere around 70 million or so. That's the normal cost. So in the 90th percentile, the UL will be gone. So clearly, under this approach, you're going to have higher contributions. So the issue is, what does it do to the funded status of the plan? And that's the next slide. So the expected funded status improves, not a lot, but you do have a lot more upside if you look at the dark green above the gray. I'm looking to the far right there. So our conclusions are consistent with what staff had recommended. It's going to result in slightly higher contributions, but a better funded status, greater upside results in later years, and most importantly, this will facilitate future de-risking of the portfolio as compared to allowing the contribution to be lowered. And we would concur with the staff's recommendation.
Gene, if the investment returns are spectacularly good, and we end up well above the dotted line that Aon was showing us, and we achieved 100% funding status in 10, 12 years, would this floor ever become effective? Or would the city and the Port District never really have to deal with the floor because they would have achieved the 100% funding ratio?
Well, it's when you have good results that the floor is effective, as Greg had said. But at some point, if you get to 120 or 30 or 40%, some future board certainly is not going to want to go up to 200% funding.
Well, this actually says that it's until such time as the fund achieves 100% ratio. So the floor goes away at 100%, right?
Yes. But, yes, I'm sorry.
It doesn't go away. It becomes ineffective. It becomes
But as Greg has said, when you have poor results, then you're paying much more than the floor. So that's where we're saying it's ineffective.
It's ineffective then too. Okay.
Right. But yeah, so it's effective with good returns up until you get to 100% funding. And I asked the board to indulge. I'm not 100% there today because it looks like I have something that I caught on the plane. From Chicago, by the way.
Nobody's shaking hands with Gene today.
Johnny did.
Or Johnny.
Nobody shake hands with Johnny either. Oh, wait, nobody ever shakes hands with Johnny. That's okay, all right.
Are there any questions or comments?
Yeah, I have a question. There's a lot of colors here on page 6, and I'm having a little bit of difficulty understanding where it crosses the 100% line. How do I tell where the 50 percentile has crossed the 100% line?
It hasn't on the expected line, but if you look at the top of the yellow,
yeah,
that crosses it somewhere around 2032, and we're basing our analysis on the 6.5% assumption. I'm not sure if the previous analysis was based on 6.75.
Yeah. So the yellow is 40 to 60%. Is that right?
Yes.
Yeah. So the top of the yellow would be 60%.
Yes, and we're not even going out 20 years. I believe their analysis was going further. This is just a 15-year projection.
Right. Okay. And what are these black and red bars here that?
The black is the without the floor, what the distribution of the funded ratio is without the floor, and the color, the red, green, and yellow, that's with the floor in place.
I see. Okay.
So you see on the far right, the last two bars, the black and the red, the expected funded ratio is higher with the floor. And there's higher upside with the floor.
And this is assuming that we have sunny skies, right?
No, this is assuming that you've got expected returns of, it's a little bit different from Aon's. We're using 6.5% expected return, but a standard deviation is commensurate with what they had in their report if you had a 6.5% expected return for the portfolio.
What I meant is there's no winter here.
Yeah, there's winter. The winter is the red.
Red.
Oh, the red, okay.
I mean, look, the red is down. In fact, I think it's consistent with their analysis, touching below 60%.
You're getting close to 50.
Right, I think their analysis got it down almost to 50.
Well, this may not go they may have gone 2 standard deviations or to the
They also
95th
went 5 years
percentile.
further.
Oh, I see,
Yeah.
okay.
Right. All right.
So we don't
It's
see
open floor if anybody else wants to
downside here.
speak.
I'll speak. So I'm going to think out loud to see if I understand this correctly. So this floor is based on there being a cliff later, and we're going to use that space to pay the unfunded liability. Do I have that correct?
I don't think it has anything to do with the cliff.
Okay.
It's just, you can forget about cliff. This is simply saying that we're not going to drop the funding for the UAL until we reach 100% funding. So in fact, it's modifying your amortization policy by pumping in more money until you get, if the contribution otherwise would have gone down, we're going to not let it go down until we reach full funding.
Well, that's what he's asking, the cliff. So on page 5, you look at the horizontal lines, the pink or purple is the current scenario, and you see the cliff in between 2027 and 2028, the city's contribution declines, the purple horizontal line. And in the assumption of the floor, you have the black horizontal line, and it doesn't.
It's a floor.
Well, it's more modest.
Yes. I think
Is that what?
it is more modest.
And then it
'cause you may
stays,
reach
and then it's flat thereafter. So it doesn't keep going,
the expected, right?
right?
Thank you.
Okay.
We used the cliff in a different context several meetings ago, and I was trying to
Oh, yeah,
not
there's a lot of cliffs around here.
Oh.
It's very dangerous.
Nobody jumps.
More of a steep
So
slope.
what word should I use? So when the
decline.
when the decline,
Yes.
if the decline doesn't occur for whatever reason, judgments and change in plans, is there any need for the floor, or does this floor still work because we don't have the decline?
It escalates the amortization of the UAL, and you get to 100% of funding sooner.
It pays the debt faster.
Yes.
Right. But now we have an open plan instead of a closed plan, which changes the dynamics if we need to.
We don't have an open. We have an
No,
open.
I'm saying if it changes, if you know.
Yeah, if it changes, there might be less of a concern about generating the cash as the plan matures. But I don't think that funding the plan is driven entirely by that.
Agreed. I just, but I guess that goes into the timing if we should be doing this. Because I like the idea of a consistent plan we can at least count on, a base budget essentially. But I wish there was certainty in the plan, open and closed, and then we could initiate, if there's some certainty in the future.
I think in 5 or 10 years we'll know.
Yeah.
So to that point, what's the difference between voting for this now versus 5 years from now or 10 years from now?
It'll have no impact on this valuation, but as I understood it, this board, many members are leaving, and they wanted to put in place something that.
I'll be here. I'll cover you guys.
If I can address, the one thing, two things. One is that even if the future unfolds and that they reopen the plan or if members do come back, we will still have this unfunded liability because it pertains to members who are currently in the plan. So we will still have this payment structure, and we will just be, as President Hoy mentioned, we will have additional contributions, better cash flow going forward, but we will still have this structural issue to address. The other thing that, as a body, the best thing we can also help our participants, namely our plan sponsors, is to telegraph what we're doing.
Right.
And so by taking this course of action today, they can plan based on what they believe their payment flows will be, as opposed to doing it in the immediacy where that may impact immediate budgetary plans.
And you touched on that a little bit when your initial comments. Port or airport, they need this plan by 2029. I didn't understand that part. If that's what you said.
If we look at the staff memorandum on page 3, there is 2 excerpts from the 2018 actual evaluations, and it shows underneath our base case scenario for the city and the port, what we anticipate, if everything goes exactly like the actuary says it's going to go, which we know there'll be some deviations to that, but if everything goes and we meet all of our plan assumptions, we will see the city's projected payments begin to drop in, let me just make sure I don't misspeak, in about 2029 significantly, and then also the port a little bit sooner in 2027.
Okay.
And Jeff, I think it would be fair to say that I sense there's a supermajority of this board that would not like to see the contributions drop precipitously at a time when the city's not 100% funded, given the history of this plan and the desire to secure benefits for members. I just don't think there's any desire to do that. And so the sooner we let everybody know what's going to happen, the better, so that they can plan on it. Karina, you're next in the queue.
Yes, and it was just a question for Jean. What's the difference in the effort to be sort of more transparent and straightforward? Why would we call it contribution floor as opposed to minimum contribution?
You could call it that. In fact, you could. I don't see the difference. Contribution minimum, contribution floor. To me, that
It's really an accelerated contribution.
Well, except accelerated may imply that it's increasing, and it's not.
Yeah, it's not implied.
it's an
Still making
acceleration
back-
of the amortization.
It's an
of the-
acceleration of the retirement of the debt, but it's not an acceleration of the payment.
At a minimum, you're going to be contributing this amount. It could be more, but at a minimum, this is your minimum contribution, so budget for that.
And you will be contributing more over the next several years because we are above that floor.
But whether you use the word minimum or floor, it's the same policy.
Yes.
Yeah. Thank you.
Tanasi?
I'll pull myself out, sorry.
All right. Bill?
I like this plan that staff came up with on the floor. I was proposing setting a date out in the future, and I can see the issues around that. But this is really nice. It gives the city a set payment that they know they're going to be making every year, outside of changes in the fund if the market went down. But this gives more predictability to the unfunded liability out in the future, and allows the city to be able to plan ahead for these minimum payments.
Thank you, Bill. Tanasi?
I just want to point out that we've talked about it being the benefit of the plan sponsor, and while I agree with that, I think that has huge benefits because if the city council can figure out what it's going to do and everybody can figure out how to deal with it. It also has another important issue that I keep coming back to, but I don't hear reflected, which is this also helps the unions in their collective bargaining, because instead of this being this unknown number out there that some actuary calculates in the back room, when you're sitting down bargaining, at least both sides, there's full transparency. Everybody knows that this is going to be at least the minimum payment, and so now we have transparency. We're getting to a better agreement between both sides, and I think that helps as well.
I'm next in the queue, and I just have thank you, Tanasi. I have a question, and this may be more for Steve and Phil, but the question is, with this policy adopted, and in light of the 78-22 ratio that we've reaffirmed today, could we predict what the likely date is for the retirement of the unfunded liability at the 50-50 range, so that we all know, okay, we've now adopted a set of policies that has an even chance of reaching 100% funding by this year? And I see Steve and Phil are nodding, but I don't know, maybe somebody's
Nodding,
but
was that a yes/no answer?
They were nodding yes. I think they're working on it.
We have
but
the projection
You may
model
already
here.
have it.
Yeah, we have a projection model here.
All right. What's the year?
It's going to be, yes.
Bill's salivating right now.
Yeah. And each of you write your answers down on a piece of paper and send them up.
275. It's not going to change much because we're having the returns be the same. Oh, look at this. Okay, so down below you see the contribution floor in effect.
Yep.
And up above, we have 100% funding. I can't read from here, Alice, it's too small.
Yeah, the sizing got.
Can you?
Which one?
Tanasi?
What year is it
Have you
full funding?
removed?
Okay, right there, in 2039.
2037 is what I thought the year would be.
Yep.
Yeah, that's, because it's shifted for the
Yep.
timing, yes. 2037.
And you see where the floor is operating in the bottom chart. This is a good graphic. It would have gone down, and we're maintaining that 275.
So we've advanced it by 2 years?
No, Alice put in,
So here was 100%, 2048.
11 years.
We advanced the 100% funding goal by 11 years doing this, based on.
So then we're
a
done. We can go
50-50.
home. We don't need the board anymore? No? Okay.
That's significant.
Yes.
Bill?
I think my last comment is, it appears, so staff has recommended this, Chiron has supported it, and Aon has said it's not going to make that big a difference in their projections for the asset liability study. So I think it's a go myself. I mean, we're getting recommendations from everybody to do it.
I would like to make the motion, but I have Jeff in the queue first.
One more question. Are we being this board, essentially wiping out what was thought of the pension savings of Prop B by approving this? No?
No.
Explain.
No. Because that was a savings looking at all contributions going, forward. Here, we're just changing the shape of the contributions, but the present value is going to be the same.
Jeff,
Yeah.
may I? So in the legislative analysis for Proposition B, the savings did not come from closing the plan. The savings came from the pay freeze. So the legislative analysis for Proposition B actually said it would be more expensive to go to a DC plan. And we don't have the data to show whether or not that has truly happened, but that was what the original legislative analysis said.
Okay. Good.
Thank you, Marcel. Mike?
Forgive me if this is naive, but what is the impact to the actual member of this one going forward?
Not naive.
It's improved benefit security. It doesn't impact the member's contributions. So it's positive for the member, positive for the city. Somebody said positive for the union. Recommendations from everybody. So
It's positive for everybody and it's fair for the sponsors is, I think, what we would conclude.
In other words, if we were a political body, we couldn't vote for it. But since we're not, it's okay.
It's actually good public policy.
Mr. Chairman, can I make a quick comment?
Of course. Thank you, Steve.
I think we heard that someone said that this improves the funded situation by 11 years from the current contribution policy. Is that?
yes, that's what we came up with.
So our analysis suggests that it's less than that. Of course, we're using slightly different data points, but it does improve it by a couple of years in our analysis. I think maybe 2 or 3
Do you agree with 2037 as being the target date for achievement of full funding?
Yeah, there are a bit of, there's some assumption differences in our analysis, but to pick the 2037 point precisely, the current policy as it stands now, we project 107% funding was the ending point of our projection analysis. With the floor, we project 111%.
And what's your expected
In that year.
earnings on that?
So we're assuming 6.91%
there's the
expected
difference.
return. I think you have a 6.5.
You've got a 0.41%
Yes.
higher return
Each year
assumption.
compounded.
That's right.
Right.
Yeah.
So we're more conservative.
That's the difference. Yeah, understood. All right. There's no one else in the queue, so if I can have a motion button, I will move to approve staff's recommendation. I have a second from Jeff Wallace.
Ready to vote?
There's no answer.
Bill?
Bill, you need to vote.
I did.
Do not vote
Not
at
go
all?
through?
Okay.
Didn't go
Got
through.
you now.
Didn't go
All votes are in.
All right. That carries 13-0.
Hey, hey.
I think we can all be very proud of what we did today.
Very good.
And thanks to Bill and Val for leadership around this issue. I think it's been a great
And George.
discussion. And George. Yeah, I think it's been a great discussion, and I think this one of our subsequent items regarding the timing of how we do things was sort of generated out of this, and that's a really great outcome as well. So
Thank you, Carol.
thank you.
All right. Next agenda item then is staff's recommendation to set the amortization of assumptions and methodology changes to 20 years. And Greg, do you want to make any preliminary comments on this, or Marcel will? Thank you.
Thank you. So this is another item that came out of the board retreat and something we've been discussing for quite some time. The recommendation is to lower the amortization period for changes in methodologies and assumptions. It is a prospective change only that we're recommending, so it would be effective with the 6/30/19 valuation, and it would only have an impact on that valuation if there was a change that the board made. So if the board made a change to a methodology or an assumption in that valuation, then this would apply. Looking at the Conference of Consulting Actuaries, the California Actuarial Advisory Panel, GFOA, and the Society of Actuaries all recommend amortization periods of somewhere between 15 to 20 years for changes in methodologies and assumptions. So this would put us in line with those policies as well.
Thank you, Marcel. Is there any presentation on this by Chiron? There's not. Okay, so this is open for board discussion at this point, and he's not in the queue, but I'm calling on Bill Hayner.
Well, so I obviously have been a proponent of lowering amortizations in general. I think this is a good one, very good that we're going to move it from 30 to 20. I would like to see 15, but I think in looking at our peers, that the average is somewhere around 19, I think is what Greg had shown in a chart. And so 20 is reasonable, and it moves us in the direction we're trying to move.
Baby steps. Anyone else want to comment on this or discuss it prior to a motion? Then I'd like to see the motion button up. And Bill, would you like the privilege of making the motion? You have. A second from Carol.
Ready to vote? All votes are in.
This also passes 13-0, and I think this is another sound policy change. Thank you. That brings us to item 4, the motion to set a 100% funding ratio target for all plan sponsors in their respective June 30, 2018 actuarial valuations. And Greg.
Yes, thank you. At our board retreat, we also talked about having a hard date to achieve 100% funding, starting now, but funding by 2038, having 100% funding ratio. And the board's current funding target is currently 100%, but the motion would mandate for sure that we would hit 100% by 2038, as opposed to our current funding methodology, which would be more flexible to do it earlier, sooner, or later than 2038, depending on the gains and losses. In practical terms, a motion of this sort would shorten 7 current amortization periods for changes to actual assumptions and methods for those periods from 3 to 10 years shorter, so that they would be completed by 2038. And should we have any actual gains and losses in future valuations, they would be set that they must end by 2038. There would be an immediate increase in employer UAL payments due to shortening of the current amortization periods. And the one downside of this motion would be that closed-ended amortizations have potential risk when you get to the end of the amortization period. Should we have a significant actuarial loss, we'd have to amortize that into the employer rates over a very short period of time.
Greg, you mean it should be 2019? All right, Greg, let me ask you, is this George's motion?
Yes, it is.
Okay, so this is the motion that I promised George we would consider when we were at our board retreat meeting. George, do you wish to make the motion?
Yes, I do, but I would like to speak to it first.
All right.
So let me just say that I'm less passionate about this, given the fact that we passed the earlier motions, because we're hearing both from Chiron and from Aon that the likelihood is that we're going to meet this 100% funding before 2018. Sorry, 2038. Whatever the date, you understand.
There is a typo in the motion that the date of 2018 needs to be changed to 2038. So Cynthia can go ahead and make that change, I think.
Right. You know, and I understand the concerns that Greg has raised about what happens towards the end if, you know, we have some catastrophe and maybe the city has to double their contributions, which would be, you know, a non-starter. So I understand that concern. I think it's still worth considering this motion because it makes it clearer what we're talking about in the first motion, which is that we expect to have this unfunded liability go to zero in 20 years. So I think it clarifies our intention, and so that's a positive point. And the second point that I would make is that just because we pass these resolutions doesn't mean that some future board can, you know, is bound to stick with them. They can change it, and if there was a disaster in 2034, I'm sure that they would make amendments to take care of that. So I think that the primary benefit is that it gives really clear notice to all parties as to what our intention is.
Okay. All right. Thank you, George. Tanasi.
Thank you. So, while I agree conceptually with what George is trying to accomplish, I'm actually not in favor of this motion, and I'm not in favor of it for a couple of reasons. One, I think that setting an artificial date is inappropriate. Quite frankly, I want full funding as soon as possible. I think what the board has been doing and what it continues to do and what its job is to figure out how to best do that on an ongoing basis. And that's the discussion that the board is grappling with all the time. By putting an artificial date out there, what I think the possibility that I'm concerned about is the opposite problem, which is, hey, we get really close to full funding in 2027, and some board says, oh, well, we don't have to be full funded until 2038, so we can change our assumptions and we can back off. And so, quite frankly, I think that from that perspective, I'd rather not have that motion because the date is artificial. That's the only reason for it. Although I completely agree, George, with what you're trying to accomplish, I just don't think that this is the best way to do it. But I do like the last motion we passed, which is to put a floor on it. I think that's helpful. And from that's just my opinion on that issue.
Could I respond to that?
Sure.
So I think it's I take your point, although I think it's less likely that we would have early funding rather than late funding.
I'm an optimist, George. I'm an optimist.
Yeah.
I don't know. I saw
Well, given our past performance, I think you should take it with a grain of salt.
I thought Phil gave us some pretty good reason for hope. But, I'm the next in the queue, and I'm going to just say that I think I tend to agree with Tanasi for a slightly different reason. While I am concerned about some board misusing this to say we don't need to fund until 2038, my even greater concern is that we're passing this to make a political statement, but it's really not good law. Because if we're a long way from 100% funding in 2038, what I'm hearing George say, and I agree with him, is some future board is just going to put this in the trash can and come up with something new anyway. So it's not really effective to do anything. On the other hand, if we're really close, then we don't need this. And if we've already achieved it, we don't need it. So I am fully in favor of saying that the point of the first motion was to give notice to the world that we are going to be funding this plan 100% as soon as we can, consistent with our fiduciary duties. And we're going to even establish this minimum payment plan in order to make sure that we do it as soon as we reasonably can. And 2037 is the expected date, and we might even get there sooner. I think that's really good stuff. But if we set this date of 2038 and say everything has to be amortized to that date, I'm afraid what we're doing is we are either doing something that's unnecessary or we are doing something that's not going to be possible. But it's going to be one or the other. There's sort of no middle ground. So for that reason, I'm not going to support it.
May I answer that?
You know what? If you answer everybody, no. But you may. But go into the queue with everybody, and we'll come back to you.
I'll go in the queue.
Because Jeff's been waiting in the queue.
I just, on top of what everything has been said already, I think we've already accomplished that. This with the document that the board agreed to with the belief, I told you to say take your beliefs, but all I can think about is belief. That policy that says this is out of the board.
Objectives.
Thank you. And so I think that's sufficient for what this motion is for.
All right. Karina, it's your turn.
Yeah, just quickly, I would say that, 2008 is maybe a once-in-a-lifetime event, but 2038 could be the next 2008. And if it were, that would not be a good position to put the plan sponsor in.
George?
So it is true that that a future board could undo this motion, but could also undo the first motion that we did as well. And so I'm thinking maybe this is a belt and suspenders notice that would make it very clear what our intention is.
Appreciate that, George. I think if I'm next in the queue, by the way. I think if a future board were to undo the first thing that we did, that would shine a light on some very bad policy. Whereas what we're talking about here is if the board were to undo this motion, it probably would be good policy. So I see a big difference there between undoing the first motion and undoing this one. Anyone else want to jump in the queue? We're using the queue, so George, if you want to respond, feel free.
Yes. So I would like to alter my motion to say that basically that the board, it is the sense of the board or the board's expectation that the plan will achieve 100% funding ratio on or before June 30th, 2018.
38.
38. Yeah, I'm confused by this 18 here.
So you're proposing to amend this to say that it is the board's expectation that all plan sponsors will meet full funding on or in or before 2038.
Right.
Okay.
So we don't force anything, but it signals clearly what our expectation is, which we've heard from our advisors that is a reasonable expectation.
Right, and I think even it would even be reasonable on that motion to say 2037.
If you'd like to alter my motion, that's fine. So could you, who's ever doing it, Cynthia,
would you mind
alter this
repeating it,
motion?
George?
Let's
so
repeat it slowly for
CJ can write
Cynthia
it?
before I go back to the
Are we
queue.
going to actually add to the one we already
We're
have?
gonna change it entirely.
We're going to alter it.
I have to find a spot to get to.
So George, you're going to need to speak it slowly for Cynthia, or play it pretty for Atlanta, whichever you like.
Yeah, well, I'm not too good at crafting these things, but basically, the motion is it is the board's expectation or anticipation that all plans.
You gotta go slow.
Expectation.
You're clearly not a lawyer.
No, praise
Expectation.
God. It's the board's expectation that all plans will be 100% funded on or before June 30th, 2017.
37.
100%
37, yeah.
100% funded.
On or before June 30th, 2037.
June 2037. Motion to expectation that all plans will be 100% funded on paperwork. Something like that.
Get rid of the word
Motion to
and.
approve board's expectation, you don't have to say and. Just say that all plans will be funded, will be 100% funded on or before June 30th, 2037, right? Take out the word and.
There you go. I believe that is now the motion on the floor. And Bill Hayner, you're next in the queue.
Yeah, I felt it was important to do a set a date, but it is an artificial way of doing things. However, I like the idea of our setting a policy that it's our intention, being clear on our intention, because there may be some wiggle room with the first one we pass. And so by putting our intention out, we make it very clear what we want to do.
Next is Tanasi.
Okay, George, thank you for the amendment. I still cannot vote for this, and let me explain why that is. From a fiduciary standpoint, I cannot tell people I'm okay with this plan being funded 20 years from now. I think that violates my duty. It may be that today, based on the assumptions and based on what our professionals are telling us, that it's okay for me to exercise my duty and my right that glide path is currently okay. Don't mean to misuse the term glide path. But when circumstances change, it may not be okay anymore. And it's important for me as a board member to make sure this plan is fully funded and solvent as soon as practical and reasonable, given all of the circumstances and all of the assumptions and all of the inputs. So while today, 20 years may be fine, 5 years from now, that may not be okay. It might have to be 10 years or 5 years, or maybe it's 30 years, 5 years from now, okay? But the point that I'm making is that by setting even that policy, to me, it's a difference. A policy that says, we're going to have a floor. You're going to have to pay at least this until you get to funding. That's fine. That's a mechanical issue, and that's helping you achieve a goal. But to sit there and say, I expect this to be funded on or before some future date, it's to me, I can't do that as a fiduciary in good conscience. So that's why I agree with the concept, just can't vote for the motion.
Thank you, Tanasi. George's amendment resolves my concerns with the motion, and while I understand Tanasi's points and appreciate that his position is a reasonable one, I think all this does is state reality, that our plan has an expectation in it that by this date that will be 100% funded. So I don't see this as harmful. I see it as simply clarifying what our consultants have told us in terms of the timing of full funding based on the assumptions that we've adopted today. And for that reason, while I don't have strong feelings for it, I also don't have strong feelings against it. I think this is what we've done.
I agree, this is what we've done.
George, you're next.
Yeah, Tanasi, I would think that since we have the opinion of two experts, Chiron and Aon, that it's reasonable from a fiduciary point of view for you to have an expectation that we will be funded on or before June 2037. So I'm confused by your statement that you think your fiduciary duty blocks you from expressing this expectation when our two consultants have told us that we have an expectation of achieving that.
Thank you, George. Bill?
Again, I think this motion clarifies our intention. I think that the first motion that we passed is, as Tanasi said, more of a mechanical way of getting there. And I think that the mechanical way of getting there is good. It's great. I like it. But by putting this out, it really clarifies where we intend to go with this. So I support the motion for that.
All right. The queue is now empty. We probably would like to have a motion button for George. George has made the motion. Bill has seconded the motion, which means we still don't know how it's going to come out.
Ready to vote?
All votes are in.
All right. This motion has carried 10-3. And so we move on to calendar item 5, which is the calendar of actuarial annual activities. And Marcel.
Good morning again. Still good morning. So this is another item that was addressed at our board retreat. There was a request to have a calendar of the actuarial items that come before you. And in looking at this, we are proposing a change. We have, over the past few years, reviewed economic assumptions on an annual basis, and we have reviewed demographic assumptions every 5 years with an experience study. Our recommendation is to combine those two and do it once every 3 years. Doing that would allow the board ample opportunity to look at our long-term assumptions to ensure that they are performing as we expect them to and determine where we need to make changes. So with that, I'm happy to answer any questions you may have.
Mike?
Can you touch briefly on the fiscal impact of that change?
Sure. So the fiscal impact is that we currently do the experience study once every 5 years. Doing it once every 3 years would be an increased cost in doing it once every 3 years. It's not an increased cost in the current contract we have with Chiron. That contract did contemplate a experience study to be done within that term, and this doesn't change it. There still would only be one within that term.
It's an administrative cost?
It's an administrative cost. Right. In the past, we have done them both at 3 years and at 5 year intervals. The last couple years has been at 5 years, but for several years before that, we were looking at demographics every 3 years.
Thank you, Marcel. I think we can just waive the queue. Almost you're next, and then if anyone has any other questions or comments, feel free to speak up.
My question is, when is the last time we did each one of these various analyses that we're now going to combine into a triennial review?
So the last time that we did a full demographic study was with the 630-15 valuation. The results were presented to the board and used in the 630-16 valuation. The last time we did a economic was last year. So that's why this 630-18 valuation has us going from 6.75 to 6.5.
And when would be the first time we would do a triennial review based on the calendar that you're proposing?
Well, after Alice recovered from the heart attack I gave her, it would be this year.
Okay. My only comment is that I feel like we've been making a lot of very strong and solid decisions over the last several years, changing the discount rate, changing the amortization rate, et cetera. Again, I'll repeat what I think most of us know, and I've said before, is I think we're among, if not the most conservative and pension system in the state, if not the country. I think with the actions we've taken today, we are positioning the system to be on its way to full funding. I'm a big fan of the calendar and the predictability that the calendar provides. I think that I would be a little bit more comfortable if we deferred by 1 year the first triennial review, given all of the activities and analyses that have already taken place over the last several years. One of the factors that causes me pause to give it another year is because there will be a at the city, the labor contracts reopen up in the next 12 months, and so there may be some additional information that comes out of the results or the conclusions of those that may be more valuable to give 1 more year to the first triennial review, unless staff has some competing arguments that they would like to make. That would be what I would be more comfortable with.
One of the things that we did look at almost was to have this review happen close to the asset liability study that we just had from Aon. So if we bump it out a year, then you're going to have, going forward, the asset liability study, and then a full year later, the experience study. So that was the only thing that we were considering in this, and I think you can still make it work by pushing it out 1 year.
But there's a benefit to doing them together, or?
I feel that there's a benefit in doing them together because of all the information that you are getting
Well,
from
they won't be
ALA.
together because this one was already done and ours
Right.
won't be till next year.
Right.
So it'd be another year, and based on some of the comments that I heard Val make and some of the rest of the board members make, by bumping it another year and combining all those efforts, you may get at that, the asset mix of 78-22 versus 70-30 slightly sooner because of the tweak to the calendar that we would be making. So you would have another opportunity, more like 2 years from the most recent one, to take a look at those percentages.
Can I invite Gene and Alice to weigh in on this issue? It seems like it's actuarial in nature.
The reason, this used to be the calendar originally when we first were on board, and the reason it was switched to a one-year economic is we knew we were at 8% and we wanted to get down at 8%, so we needed an annual review. On the demographic side, the reason we went to 5 years, there really isn't much of a difference between 3 and 5 as far as the long-term impact on the fund, and there was the issue of substantially equal member contributions and didn't want to change them every 3 years. That was the primary factor in going to 5.
How do you feel as between the motion that's on the floor and Almus's suggestion?
From an actuarial point of view, there's no difference.
Okay.
Gene, if you forget, I appreciate Val's question, but if you were going to engineer when we would start these different things, and staff's opinion and board's opinion didn't matter, how would you do it to be most efficient, most effective, and most meaningful for the system? When would you start each of these issues?
Well, there's only one issue. It's the demographic.
Right, but where would you time it?
A range of 3 to 4 years.
Where would you?
We're fine with 3, 4, or 5.
Okay.
So when is the next demographic change going to come from the U.S. government? Is it every 10 years, and the last one was
you're talking about
2010 or
Society of
2011?
Actuaries comes out with mortality studies.
Mortality study, yeah.
They've been coming out with it every year.
Every year?
In the past several years, yes.
Oh, I thought it was adjusted every 10 years.
No, you're thinking of something different than
That's
the
the
Society of
census.
Actuaries.
That's the
Oh, the
census.
census, yeah. So is the census really the basis
No,
for the mortality study?
Not at all.
Okay. Sorry.
The last time we did one, as I recall, we were relying on a CalPERS study that was specific to California
Yes.
public employees, which was more meaningful to us, I guess, than maybe a more generalized national study.
Particularly for the active members, because there are so few deaths and they have a much larger population.
So how frequently do we anticipate that the larger systems, CalPERS, CalSTRS, or SDCERS, or other large systems that have the resources to do this, how frequently do they come out with new actuarial data or demographic data?
CalPERS has been doing it every year for quite some time, right, Gene?
I'm not.
On demographic?
On mortality, not on full demographics.
Well, how often do they do their experience studies?
I wasn't aware they're doing it every year.
I don't think they're not doing the full experience study every year. It ranges.
There might be. All I'm suggesting is there may be some value in coordinating with their reports, since those are the most useful inputs to our demographic studies.
Well, we're not going to start this study until after this March meeting. We'll be back. We can probably bring that data to you at the March meeting.
The motion doesn't tell us when to start this process. It just tells us that we're going to change it to every 3 years. So I think we have some time to decide.
So if we vote for this motion, we might defer for a year and then start the 3-year increments.
Yes.
Does that satisfy your concern? So I think we can support the motion as drafted, but we still have the question of when are we going to start?
Correct.
Okay.
Can I just ask a question? This may be a dumb question. Part of this is that we're not going to review the discount rate annually. We're going to review that every 3 years.
Correct.
Okay. And that'll be in the same year as all these other things, whether it's this year or next year.
However, that would not preclude some future board from saying, you know what, we'd like to jump in here, something's happened.
Right, because we're still going to get the annual capital market assumptions, and obviously we're looking at the markets. And
Right, and this says at least every 3 years, not, so it's, the way the motion's worded, you could do it more frequently if there were a reason.
Sure. Oh, good point.
Okay? We can have a motion button. This motion has been made by Almas and seconded by Bill.
Ready to vote? All votes are in.
And it passes 13-0. Great, thank you. This brings us to two non-action items. First is the analysis addressing liquidity, cash flow, and lower investment return assumptions. I'll ask Greg to kick this off before Gene and Alice weigh in.
Thank you. At our board retreat, we did talk about looking at the plan, addressing liquidity, if liquidity was an issue, looking at cash flows from an actuarial perspective, and also if we lower our investment return over time, what that would look like from a sensitivity perspective. On the first of those issues, we had a very good presentation earlier today as part of the asset liability study where Aon was looking at the liquidity issue. Could we make pension payments? And the answer to that was yes, we could. There's some information in the staff memo and a excerpt from the asset liability attached to this agenda item on that. In addition to that, Kyran did some studying on kind of the cash flow and what happens if we have a few bad years to begin, and from a cash flow perspective, what it does to our funding, and also if we gradually lower the discount rate over time, what would that look like?
Okay. On the negative cash flow, I think a comment was made that once your negative cash flow exceeds 5%, there's some concerns. And clearly from the Aon presentation, from a liquidity point of view, that wasn't an issue, and we were coming from it from a liquidity point of view. We're showing a picture here of SDCERS if you had no negative cash flows, and comparing your assets at the end of a 10-year period if you earned 6.5% each and every year, versus if we started with a down market followed by an up market, but yet over the 10-year period, 6.5. And it shows on the right-hand side, the assets are identical. The next chart looks at SDCERS actual cash flows, and the answer isn't the same, and that's because there's a difference between time-weighted and dollar-weighted returns. And if it got worse to 5%, the disparity is even greater. But in the end, our conclusion is that first, Aon Hewitt correctly addressed the liquidity issue. We talked about if it went approaches 5% of assets, but that's not happening. It's a long-term issue, so we don't think this is a factor that should be driving board decisions at this time. So we will keep it in front of the board if and when it becomes an issue.
Didn't we see something, Greg, maybe it was you who was presenting it, where we were getting to north of 4% in one of the projections?
Quite a few years out, yes.
Okay, so how does that, I mean, I thought 4% was a pretty risky number. What is it now? How does that square with what Kyran is saying about 5%?
It's, again, we're not addressing liquidity. If I go back to slide 3, both returns are 6.5%, but the red line is based on a bad returns in the earlier years, followed by up returns in later years. And as you can see to the right, the assets aren't the same. Because with negative cash flows, once the money's out the door, they're not available to be reinvested, to earn back those losses. You have fewer assets.
Okay.
And I think, Carol, you were talking about negative cash flows as a percent of assets earlier during the presentation, and it's not a liquidity issue. It's can you achieve your rate of return?
If I can jump in, when we addressed this was part of the environmental scan at the board retreat.
Yeah.
We were looking at the cash flow as a percentage of assets.
Right.
And seeing from a liquidity perspective, more from what Aon was looking
We were trying to, from a liquidity perspective, we were trying to keep it well under 4%.
Right.
Was sort of the goal. Is that sort of right?
Again, what we were doing is we were looking at the fact that we are in a negative cash flow. Did we need to look at that from a policy perspective? Should we do something else with our asset allocation? And we were basically looking towards the consultants to say, hey, we're approaching this, we're currently at -2%.
Right.
Is that good or bad? And in the future, we're going to be at -4%. Is that good or bad? So again, I would look towards the investment consultant and the actuary to say, we recognize we're in a negative cash flow. Is that sustainable, yes or no? And we've heard back from our investment consultant that said, from paying the promised benefits, being able to manage the portfolio, we're in an acceptable position, we're okay.
All right.
And then from an actuarial perspective and funding, I think Gene is showing us that when you do have negative cash flow in a down market, it's just harder to fund the plan.
It's kind of a compounding problem.
Right.
Okay. The second topic is looking at lowering the discount rate. If you recall at the board retreat, a few board members asked if we could modify our modeling to allow for a glide path down with the discount rate to 5, but perhaps only do that in positive years. So if I shoot to slide 6, that is looking at a Monte Carlo analysis of having a $275 million floor, as we discussed earlier, but also, and these are the colored bars, lowering the discount rate from 6.5 to 5 in 25 basis points increments, but only when you have positive returns. And it shows on the actually determined contribution, and I always look to the far right bars, where are you 15 years out, that, and remember, this is reflecting both the floor and the lowering the discount rate, but the expected contributions are significantly higher at the tail end there, closer to 300 million versus the current situation. Much of that difference is due to the floor. So I don't think this slide is as important as perhaps the next slide. So here, two things are happening on the far right. Again, I go to the far right always in all these charts. We have a lower funded ratio, but that's at 5%. But we also, with 5%, have less volatility. As you see, the bands are smaller. And Aon, in a phone call, advised us, well, that's not a fair comparison because it's 5% versus 6.5%. Let's see what the assets are at. So we also projected the market value of assets. And you could see the assets, assuming a 5% assumption, are expected to be just a little bit higher, but much less volatility up and down. And at this point, I think this was just an exercise to see what would happen. I don't think anybody's suggesting a motion or not, but we now have a model that can look at this in future years.
Right. I don't think there was a motion on this. This was just consistent with our view that ultimately we were going to have to de-risk this portfolio, and board members wanted to see what it would look like.
Yes. And that concludes this piece, and we have one more to go. So the valuation presentation is also a non-action item.
Ready for this one? Yeah.
The board practice is to have us come in January and present the preliminary results, and I think we also had preliminary val reports, right? Are they stamped draft still?
No.
No, okay. Then you're presuming they're going to accept it in March. And so we'll come back in March to address any questions as we go through this. Alice? So as usual, we look at the background, historical trends, the current results, and a look ahead. Some of this information has already been looked at in our previous presentations in Aon's. So as far as background, you're familiar with the pension tank. This is from a 1965 Harvard Business Review.
Getting old-fashioned.
I'm trying to figure out how to make it flush.
Have you seen the Toto Neo-Rest 700H?
Right. But the tank is the liabilities, and the green was the assets. And the valuation, the purpose of the valuation is to measure the size of the tank and to tweak that employer contribution valve. The valuation results that we're presenting here today are as of June 30th, 2018, and they are for determining the plan sponsor contribution that comes up July 1st, 2020. No, July 1st, 19, which is fiscal year 20. And There's many plans here. With the Airport Authority, we only have two, the PEPRA plans and its older plan. UPD has had 3 general and 3 safety. But the city has had a large number, and this is just to let you know there's different plans within the system. As you know, last year, the board voted to reduce the discount rate from 7 to 6.5, 6.75, and then 6.5 for this valuation. Alice, if you want to talk about the second bullet.
So the results of this valuation for the city also include pay increases. So effective July 1st, 2018, the city implemented across-the-board pay increases for its members. So the general membership received a across-the-board pay increase of 3.3%, which is slightly higher than the assumed 3.05%. And the police membership received a series of increases. So first at July 1st, 2018, an 8.3% increase. January 1st, 2019, a 5% increase. And then for the fiscal year 2020, the police also have an assumed expected increase coming into their calculations. So the results of this valuation reflect the increase for the police in the current results, and it also reflects the coming increase for fiscal year 2020.
And just to give you some magnitude, those increases through 1/1/20 will result in a little over 30% increase in pay over the assumed 9.2% that we would have expected. So when we get to the results, you'll understand one large part of the increase in the ADC is this feature. This slide is the same slide that Aon.
I have a question. So these pay increases, were they in your previous presentation?
They were in the model.
They were in the model.
We did have an assumption in the model because whenever the city has an increase, we do a study prior to that taking effect. And so we used our estimated value in the model for fiscal year 19 and fiscal year 2020.
I think he meant also in the PowerPoint, we were showing all the analysis. Was it baked into there? And the answer is yes.
Yes.
The answer is yes. I have the same question for Aon. Steve, had you cranked in these pay increases in your analysis for when we'd be 100% funded?
So we collected the information directly from the actuary. So if it's in the actuary's numbers, it was in our numbers as well.
Thank you.
Okay. The next slide is duplicates something Aon showed you and something that's not news. Most public sector funds have been dropping their discount rates. If you look back at 2001, very few plans were below, if any, I can barely see it, less than 7%. In fact, there's probably none there. To the far right, and this is Boston College or NASRA, both of them have this database of 126 large plans, and 14 plans on the far right now are less than 7%. You're one of them, but you can see the days of the 8%, which is the light blue, are gone. You can take the next two.
I'll cover these two. So when there are changes to the assumptions, so as in this valuation, there was the 25 basis point reduction in the discount rate, that the impact on the plan sponsor is an increase in their actuarially determined contribution, but there's also an impact on the membership. And the members' contributions get increased as well when there's an assumption, not increase, but they change when there's an assumption change. So in this case, the assumption change increased liabilities, so it reflectively causes an increase to the member contribution rates. So in aggregate, for general members, it was about a 0.7% increase of their pensionable pay, and for safety members, a 1% increase on those member contribution rates. And these rates will be effective 7/1/19. For the port and the airport, their PEPRA tier population, so those are members who were hired after 1/1/2013, those PEPRA member rates, those are subject to change when there's a change in the gross normal cost that's greater than 1%. So for this valuation, the airport PEPRA members, the gross normal cost did not change by more than 1% from the assumption change. But the port safety members, their gross number cost did change by more than 1%. So those rates were recalculated. So the portion of port safety members under PEPRA will have an increase to their contribution rates on average of 0.9%.
So now we go to historical trends. Again, this is a repetitive chart because I believe Aon Hewitt had shown this. Your funded ratio, the bars are your liabilities, the lines are your assets. The gold line is smooth assets, the bluish line is market value. You're currently sitting at 70.8%, but we know that's because we're at a 6.5% discount rate. In prior years, many prior years, they were at 8%. Oh, by the way, going back 1990s, just to make a point that 100% funding doesn't solve the problem. The system in 2000 was at 97.3% funded, and even if it were at 100%, didn't stop what happened back then, which is the MP1 and MP2 days. And that's why the drop in funding. Next one. This is comparing, probably focus on the gold bar versus the top of the dark blue. And it's showing for 2003 through 2005 how the city was underpaying what was back then the ARC, now is the ADC. And then since then, they've either exceeded or met the full ARC each and every year. This is a pattern of gains and losses. And if it's above the line, that's good news, it's a gain. If it's below, it's a loss. You can see the dramatic impact of the investment losses in gold from the crisis back in 2008 and then in 2001 as well. And how much the investment return dwarfs the liability gains and losses. Liability gains and losses were pretty much up and down. This past year, you see something significant, and those pay increases we're talking to are a large part of that. But we'll get to that, more detail on it in a later slide. Bill, this chart was built for you. Why have we seen such an increase in the UAL, 2.2 billion, I think. No, actually, it's 1.8 billion.
1.8 billion.
1.8 billion since 2008. Well, the 2008-9 investment return, that's in green. And through 2000, this most recent valuation has contributed to 675 million of that 1.8. But all the assumption changes taken together is 1.4 billion.
Gene, is the green part, is that the shortfall of the investment return versus the discount rate that the board assumed?
Yes, the discount rate is in the black.
So what we'd like is to see that green go away.
Yes, and actually, we'd like to see it down below zero so that it's contributing to fully funding.
Yeah, and if we receive a 6.91% return at a 6.5% assumption, is that what would be reflected?
Over time.
Over
yes.
time.
Then we go through the similar slides for the port and the airport. Alice, if you take them through these.
Okay, so I'll walk us through the Unified Port District and the Airport Authority, similar trends, historical trends shown here. So we see in the early years, the port was 100% funded and had similar patterns of dips that the city had. And as of 2018, it sits at 74.2% funded. The contributions, sorry, I'm gonna
I want to see you memorize
grab my cheat sheet of numbers. But so the contributions we see for the port across the period shown, so they've paid their full contribution, their full actuarially determined contribution over the period shown, with the 2020 contribution at 13.3 million. For investment and liability gains and losses, there's a similar picture on the investment experience as we saw for the city. For the liability gains and losses, each plan sponsor has independent demographics that play into the liability experience. And but similar to the city, the liability gains and losses as a percent of liability are much smaller compared to what you're seeing on the investment side. So the blue bars are closer to the zero marker. Here's the slide showing the contributing factors to the port on their UAL. So we have the largest component of increase to the UAL for the port was also the assumption changes. And the two assumption changes, so the economic plus the demographic, was about $100 million increase for the port, whereas the investment experience was about a $30 million increase on their unfunded. The Airport Authority, we see consistently that their funded ratio is higher, and that's because of their internal policy to add additional contributions to the plan when there is a funding ratio below 90%, and another trigger for additional contributions when the funding ratio is below 95%. So we see that in 2018, the airport's funded ratio is at 89%, so they'll be making their required contributions plus an additional contribution to reach that 90% funded target. And that shows here, year over year, the gold bars, the airport's contribution, they are paying higher than the actuarially determined contribution to maintain that funded ratio. Gains and losses on both investment and liability experience. The investment experience, similar picture, that 2009 loss really stands out in the period shown. And the liability fluctuates a little bit more because it's a smaller plan. So when you're basing experience on a smaller value, you'll get a little more fluctuation in those in the demographic gains and losses. And here are the components contributing to the airport's UAL. So the airport's UAL is much smaller than relative, given that they're making those additional contributions, trying to keep their UAL down with that funded ratio up. But they have a similar picture in that 18 million of their increase in UAL is due to the economic assumption changes. That's the black section. 12 million due from demographic assumption changes, and then 7 million from the investment returns. But on the other hand, the gold portion on 2018, you see that gold portion is also 7 million. Those are additional contributions that the airport has been making to offset the UAL increase.
So now we get to the details behind the 2018, June 30, 2018 VAL results. We have 3 columns. We show what happened last year, what would have happened this year if you stayed at 6, what we expected would have happened this year if you stayed at 6.75, and what actually happened, you're at 6.5. And for each of these, we'll show what's going on with membership, then assets and liabilities, and contributions. So there's not much going on in the membership. The average benefit went up slightly. The total annual benefits and pay status went from 470 million to 493. But the real news is in the next section, assets and liabilities. And maybe the most important thing are the bottom 2 funded ratios, that the funded ratio was last year on an smooth actuarial basis, 71.2. We would have expected it to improve to 73.3 if you didn't change the discount rate. But change the discount rate, you're at 70.8. A number of people believe that the more important number is your market value. Those are your real assets, and your real asset funded ratio stayed, despite decreasing the discount rate, stayed at 73.2%, which I think is good news.
Yeah.
Probably the best news on this sheet. As far as contributions, last year there were the bottom line, 322.9 million. We would have expected a drop to 317.2, but we had the discount rate change and those police pay increases, so the ADC is now at 350.5.
To state the obvious, 75, it's the floor now.
Yes.
Excellent.
Yes. And this is showing what's causing the change in both liabilities, assets, unfunded, and ADC. So I'm going to focus on the right last two columns, the UAL actual results were 2.757 billion. With no changes, we would have thought it would have dropped, and we're phasing in some additional asset gains. But the liability experience was 115.8. I think of that, 88 was attributable to the police increases, and most of the balance was attributable to the discount rate. Yes. And then we had also a change in the discount rate of the 274, and now we're sitting at a UAL of 2.977 billion. The ADC impact is going from 322.9 to 350, and the same type of components. We would have thought it was going to drop 5.7, and maybe an additional 2.5 for asset experience, but then the pay increases and the discount rate change resulted in a number at 350.5. Bertrand?
I'll go through, the similar results for the Unified Port District. So I'm going to...
Been seeing a lot of numbers today, haven't you?
Lots of numbers.
I see some
I'm
glary
going to add
eyes.
numbers to these, yes. So for the Port District, the membership active population remained stable. The salary increased, this average salary increased by 4.5% from the 93,000 average to the 98,000 average. Average benefits increased just over 3%, so based on the population there for the inactive status. On the gray section there for the actuarial liability and assets, we see that the actuarial value funding ratio at 2017 was 74.3%, and it remained steady at 74.2%. On the market value ratio, that ticked up slightly from 76.7% to 76.9% with the favorable returns. The bottom portion where we see the components of the ADC, the actuarially determined contribution, the components there bring the ADC up from 17.9 million to 19.3 million for the current valuation, and we'll see how that ADC bridged from the prior year to this year in the next slide. So here we see the components of change. We'll focus again, as Jean did for the city, on the UAL and the ADC. So the main components of change, there was the asset experience, and we see that the asset experience was a negative 1.6 on the UAL and a negative 0.1 on the ADC. So the asset experience favorable brings the unfunded and the ADC down. Liability experience brought those two factors up at 3.7 million and 2.2 million on the ADC. And liability experience for the port, there was generally the experience was that there was a bit more salary increases than expected, so there was that slight increase there. And the main factor contributing to the increase in the actuarially determined contribution were the economic assumption change, so moving that discount rate down by 0.25% increased the contribution by 1.2 million for the total contribution of 19.3 million for the port. Going through the airport authority, I'll jump straight to the funded ratio in the gray section there on the actuarial value of assets funded ratio. Last year they were at 89.2 million. This year they're at 89.2% funded ratio. This year at 89% funded ratio. So it ticked down just slightly, and that's again largely due or just mainly due to that reduction in the discount rate, which increased the liabilities.
But in this instance, it has the unintended consequence of putting them below the 90%, which that reduction in discount rate, if we hadn't done that, they would have been over 90%. They wouldn't have to make the extra contribution.
Yeah, and you see that's an
we
excellent
didn't
point
talk
to point
about
out.
or think about. Yeah.
So in that middle column, you see had the discount rate not changed, they would have been at 90.5%. And the airport, when you look at the breakdown of their contribution, we see that 4 million is of the normal cost. So that's the bulk of their payment comes from the normal cost, not from the UAL payments like we are seeing for the city. For a total contribution of 6.2 million for fiscal year 2020.
Yeah, they'll all look like that.
The components of change, similar to the port, similar to the city. There was the asset experience, favorable asset experience, brought down the UAL, brought down the ADC. Liability experience for the airport was favorable. They had demographic experience, which actually brought down the liability slightly, and that was from their decrementing. So retirement.
Decrementing, for the non-actuary. Can you
For the
explain?
decrementing. So
Decrementing.
decrementing.
I've heard of decimating.
Decrementing. So the turnover. So
Mortality.
members dying, retiring, terminating, going out on disability. Those are the
Okay.
the rates of turnover.
Everyone on the board has to use that word at least once today in conversation.
My health is decrementing right now.
So the airport had favorable liability experience. So with the favorable experience, the UAL went down slightly, the ADC went down slightly, but the main line item there, those economic assumptions, brought up the unfunded, that discount rate change brought up the unfunded and ticked up the contribution for a total unfunded for the airport at 22 million and their total contribution for the year at 6.159 million.
And typically, we end our valuation with doing a long series of projections, but you already saw a number of projections, stochastic, from Hewitt and us, and we had the P-scan model up earlier. This would have been the baseline before the board decision with the floor. If you could just flip to the model for a second. And just to remind you that once we put in that floor,
I'm sorry.
Those are good-looking kids.
the bottom graph is the more important one. With the floor, you see the gold bars exceed that red line. The red line is if you didn't have a floor.
But if you put in 6.91 as the actual rate of return, would that cause harmonization between the consultants' numbers?
Well, you never have exact harmonization.
Harmony. Or would that
all
be
the way down?
declamatory?
Sorry, are they
6.91 return
not
every year.
just-
Need to copy it down. Yeah.
And there we go. I
It's
didn't
bringing it
copy.
much earlier. So we're much closer now. Although I can't read the numbers from here.
Here we go. So we're at 100% here in
We'll look at the top chart.
2033, yes.
George, do you want to amend your motion?
No. And just flip back to the PowerPoint. The port projections, which we hadn't shown today. And
And the port, I'll just make a comment on the bottom graph there. The port has a different pattern of contribution payment, and that's because they have some more offsetting bases that are gain bases. So depending on which base drops off, then you'll see a little bit different pattern of fluctuation there.
we don't have it here, but we tested the floor with the port, and it had a much minor impact compared to the city. And we did not apply the floor to the airport because they have their own funding policy of the 90%. And that would be the last slide we have here. Now, Greg or Marcel, do you go to the airport authority once a year and share this with them? No.
We go as they request us to appear.
But
The airport is here, yes.
Should clap them for the policy.
Yes.
Greg, you had a recent meeting with the Port District, no?
We have quarterly meetings with both the port and the airport to discuss a variety of different operational
Including
issues.
this agenda here today.
Yeah, we briefly talked with the airport about this agenda here today with regards to how the floor would not be applicable to the airport due to their projected increasing costs.
And that concludes our presentation, and we'll come back in March to answer any further questions on this.
And if anyone is interested, the appendix has all of the member contribution rates that are changing.
Could you go back to the gains and losses slide for the city? City, yeah. So it goes back to 1995. Is there any chance you could just take that back to 1990 at some point?
We rely on the staff for the data.
You don't have to do it.
Present that in the June meeting.
Yeah, well,
Sooner.
maybe for the March meeting. The only reason I say that is that we had a recession in 1990, and so you'd see the impact of that too.
Have that data, you think?
I have the valuations,
That's
but
all
I
we need.
don't know that it has. We'll see what we can find. I do have the valuations. I have the valuations going back like quite some.
Whether they computed the gains loss.
Yeah, I don't know that I don't know that those valuations computed the gains and losses this way, Bill. But I will look and see, and if we have the data, I'll provide it to Chiron for the next meeting.
Okay, that'd be great. Thanks.
Thank you.
Thank you, Gene and Alice.
Thank you.
We've reached the noon hour, and I would like to just look around and see, do people want to take a break, get sandwiches, or do we want to power through this? And I will offer something. If you want to power through, I'll turn the gavel over to Tanasi. We'll be out of here in 5 minutes. We have a request for a short break, so I'm going to honor that. Let's come back in 10 minutes. And, yeah, grab a sandwich if you'd like, and we'll come back and reconvene in 10. Mine's on. Are we good? All right. So we're going to resume the meeting, go back into session now, and conclude our agenda. We're going to take business and governance out of order and proceed next with the report out by the chair of that committee, Tanasi Priovalos. The floor is yours.
Okay, thank you. So yesterday's meeting was about 12 minutes. I get a lot of excrement for the fact that those meetings go quite briskly. I would like to point out that the reason for that is I make several very important assumptions. The first one is that A, the board members actually know how to download the material and can follow Cynthia's brilliant instructions to do so, and two, that they actually can read, because I believe in the school system here. So that's the big issue there. If that assumption is not correct, you can talk to me afterwards. There were 7 presentations. Thankfully, they were all fantastic. I will also just tell you right up front that all of the recommendations were approved unanimously. So going through those really quick, the action items under item A, and by the way, my presentation isn't on the right place, so I'm just going to read off my list. Okay. Staff's recommendation to approve the Sagitech Solutions Maintenance Agreement by David Bond, that passed unanimously. And is there anybody who wishes to discuss that? Seeing nobody in the queue, action item number 2, staff's recommendation to approve the SDCERS system upgrade with Highland software was passed unanimously. Is there anybody who wishes to discuss that item? And actually, Cynthia, can we just approve them all together? Okay, so I'm just going to run through those real quick then. The third item was staff's recommendation to deny Sheila Owens' appeal, and the committee did vote unanimously to deny her appeal. Any discussion on that? Seeing nobody in the queue, staff's recommendation for the selection of a retail banking relationship. This one was, the only thing that I want to point out is what's not in your materials, if you did download and read them, was that the day before, so I guess it would have been Tuesday, Jamie had, with apparently some modicum amount of help from Ted, managed to get an additional 5% reduction in their fees, in our fees for the contract. And so I think that's a huge, huge deal. In being consistent with yesterday's meeting, anybody who would like Jamie to negotiate their fees on their accounts at Wells Fargo, please feel free to call her at 619-867-5309, I think is the number, as I recall. I'm just saying. I don't know. I was just. I'm just saying. Just go ahead. But anyway, so I think we I guess we need a motion to approve those 4 action items. Tommy Two-Tone, right.
Ready to vote? All votes are in.
And that motion passes 12-0. Okay, under new business, we had a board election update by Jessica. The nomination period for members interested in running for the SDCERS Retirement Board and the Active Police Safety Board member seat is now open and ends January 30th. The election is being conducted online, with the members receiving a personalized letter with nomination information and a unique nomination participant number. By the way, I'd just like to say I think that was the first time Jessica had presented, at least to my committee. She was quick, she was fast, she looked like she knew what she was doing. I very much appreciated that. Didn't lollygag once, so thank you. Under old business, we had there's the staff's recommendation to renumber Board Rule 1.1. That came from Johnny Tran in legal, and as we all know, that was a big yawner. But it did pass unanimously, so I think we need a motion on that one. Okay.
Ready to vote?
Somebody's lollygagging.
George Kinney?
Somebody's not doing it, Jessica. Come on, guys.
All votes are in.
All right, and that passes 12-0. There was no action requested on the next 2 items, which is update on exploring additional insurance and report on overpayments to members exceeding $10,000. Status reports. Of the 7 potential status reports, there were only 2 people who presented. Thank you very much. Cynthia praised the call center for their quality service, handling close to 200 calls per day due to our Medicare reimbursement outreach to retirees. She also introduced a new call center representative, Sarima Venezuela. Did I get that right? Okay. And Marcel acknowledged Fong Nguyen for providing benefit calculation training to finance, legal, member services, and health staff. SDCERS has received over 1,600 Medicare reimbursement forms as the Medicare Part B premiums increased from 2019. And that was all she wrote, folks. Thank you.
Thank you, Tanasi. Next, we'll go back in order to Bobby Spoon reporting out on the Audit Committee.
The Audit Committee met on Wednesday, December 12th, and we received and accepted 3 independent auditors' reports. The auditor's report for 2018, the auditor's report on internal control, and the report to the Audit Committee and the Board of Administration. And we received today from Ted, everybody, the 2018 CAFR, looking beautiful. All of the audit reports are clean, unmodified opinions. They found no exceptions in internal control. And congratulations to Ted again for receiving the Government Finance Officers Association Certificate of Excellence. So this is a long way from 2002, 2003, and 2004, isn't it? Congratulations to you and your staff.
I just want to know how many trees had to die for this, Ted, in your non-green operation. All right, just checking.
We also heard from Sarah Dixon, her first internal audit report of the Airport Authority, and her report is included in the materials. Thank you, Sarah. That's it.
Thank you, Bobby. Next, we have the Disability Committee and Sir Charles Hogquist.
I didn't know I was knighted. Yesterday's Disability Committee was rather brief, probably briefer than Tanasi's, but I don't tell as many jokes as he does. We have 3 staff recommendations to approve industrial disability retirements. All were non-contested, and all the recommendations were set up, and that was to approve the disability retirement of Mark Bua, who is present with us, also Kimberly Fives, and James Roberts. All of those recommendations passed unanimously. And I'll make a motion to approve those.
Ready to vote? Okay, all votes are in.
And the motion is approved 12-0.
That conclude the report?
We have one more item about our affidavit. I'm just trying to bring it up here. We also have a staff's recommendation to refer Sean Connery's industrial disability retirement to a hearing to determine his continued eligibility. Mr. Conway has Mr. Conway has taken a position that as a deputy with a police department back east, and he has a disability retirement from the police department. So staff is recommending that we have a hearing to determine if he's eligible for the benefit. And this motion did pass the committee unanimously. And also we were informed that he is going to be represented in this matter by our favorite attorney, Mr. Conger. And I'll make a motion that we approve staff's recommendation.
Ready to vote? All votes are in.
And I have pardon me, the motion passes 12-0. Getting ahead of myself here. And we also had a presentation by staff about making an amendment to the municipal code to represent and to update it so it reflects the recent election results from last November, which now authorizes that police officers who are involved in a traumatic incident and subsequently apply for a disability retirement for a mental or post-traumatic stress disorder are now are available to have that remedy available to them. And we had a great presentation by Johnny, and if anybody has any more questions about that, please ask him. Having no questions, I will move that we approve that motion.
Oh, non-voting.
Oh, it's not voting, okay. I have a little thing here. Okay, and then our last one is the disability status report was presented. We have no major applications that are long-term except for one which is delayed based on the applicant's issues. And we do want to commend the staff for taking care of those applications. I have been getting positive feedback at many of the retirement meetings about how they've been treated. So I do want to pass that on to everybody. And that concludes my report.
Thank you, Charlie. That brings us to the Investment Committee and Carol Broad.
Hi, Investment Committee met yesterday for a brief 2 hours, which is good for us. And we had one action item, which is a recommendation to invest $55 million in the MetLife Core Property Fund. Jamie is going to give us a brief presentation, and then we'll vote. And after that, we had two other non-action presentations. One on the ongoing analysis regarding managed futures. We're going to get a few comments from Anders and a report on performance through third quarter and some thoughts about more recent market. And Demetrios is going to report on that. So Jamie, take it away.
Great, thank you. You have in front of you staff and consultants' recommendation for a $55 million commitment to the MetLife Core Property Fund for SDCERS Real Estate Tactical Core Equity Allocation. As a reminder, the Tactical Core Equity Allocation is intended to provide complementary exposure to the core allocation by providing additional diversification and the opportunity for returns that outpace the benchmark. This recommendation is consistent with the fiscal year 2019 annual investment plan to add an additional core diversified fund to this tactical equity allocation. The MetLife Core Property Fund is an open-end core fund seeking to invest in a diversified portfolio of core institutional quality commercial real estate assets. The fund's strategy will focus on primary markets with high growth potential, particularly in markets that have a significant amount of STEM employment. The fund's objective is to outperform the benchmark, the NFI Odyssey, over a full market cycle, with returns coming from both income and appreciation. Townsend has Townsend has qualified this fund as a top quartile fund, and they have projected that their returns will outpace the benchmark over the next 3 years. And finally, the committee did approve this recommendation 5-0 at the meeting yesterday. And with that, I'd be happy to answer any questions that you have.
And I would just add that this is in part related to us divesting our Deutsche Bank individual property holdings and moving into open-end funds, which is a more diverse and less risky way to approach the core asset type. So if there are no further comments, I guess I make that motion. Is that correct? We don't need a second.
Ready to vote?
I just want to know, are you going to get a 5% reduction on MetLife's fee as well?
I tried, but
Okay.
I was unable to. But however, I was able to get us an advisory committee seat, which is typically for much larger investors.
Oh,
So
okay.
it did end up with a good outcome.
And doesn't Townsend, because of their relationship with MetLife, gets a
Yes.
14 basis point reduction in fees? So actually, it has an attractive fee.
It does have a very
Good
attractive
point.
fee.
I'm just, I mean, you're on a roll. I don't want to see you stop. That's all.
That's a good point. Okay, so that is passed 12-0, and thank you so much. Appreciate it. And now we're going to Vanders briefly on managed futures. This is a non-action item.
Not on this one.
Good afternoon, everyone. Page 1 out of 50. No, I'm just kidding. As you know, over the past couple of meetings, we've been reviewing a possible allocation to alternative risk premia and/or managed futures for the Opportunity Fund. So we started focusing on these two strategies due to their attractive characteristics that include downside protection, low correlation to traditional asset classes, which both will add diversification on the total fund level. During our analysis, though, we decided to only focus on managed futures due to alternative risk premia's short track record and wide dispersion among the manager returns, which would add manager risk if we were to look further at that. The results of the analysis show marginal improvements to the total fund, both on risk and return. And the conclusion that we can draw from this analysis is that an allocation to managed futures should reduce downside risk to the fund, but also slightly reduce return potential to the total fund. This kind of dovetails nicely to what we were talking earlier about lowering the risk of the plan and reducing some of the equity risk that we have in the return-seeking bucket. Yesterday, the investment committee supported putting forward some managers either at the March or the May meeting. This is not an action item. This is just for informational purposes. So, any questions?
And we're talking about potentially a 2 to 4% allocation.
Correct.
I think.
Correct.
Hasn't been decided. Questions? Okay. Thanks so much. Demetrios, take your time.
Jessica was faster.
I'm sorry, we're giving you a bad time.
Just a few quick points about total fund performance. As of the end of September, the market value of the total fund was just over $8.5 billion. Unfortunately, it didn't stay there for very long. And then from a performance perspective, the total fund had a net return of 2.8% for the quarter. This compares to the benchmark return of 2.7%. So good performance, both from an absolute and relative perspective. We don't have official data for the fourth quarter, but as we saw, markets were perturbed over that period.
How'd we do in the Santa Claus rally?
Not bad. Up a little over 2% in January so far. Any questions?
So, yeah, and feel free to look at the reports that are in your package. Thank you. So we had some other items that you can read at your leisure. And with that, we'll move on.
Really?
Yeah.
I wasn't prepared. Okay. Thank you, Carol. That brings us to training and Johnny Tran.
Hey, thanks. Before you, staff's recommendation to approve the list of trustee educational conferences. Greg, thank you so much for reaching out to each trustee and giving individualized recommendations based on your experience here in your committee seat. And the trustees, thank you for reaching back to us to put together this list. I need to revise it, so I'm going to pull an audible here that Ms. Coleman is no longer going to request attending the Aon Client Conference, but would like to attend the IFEBP conference in San Francisco on July 22nd through 24th. I'll make sure that the minutes reflect this, so you don't need to note anything or make any changes other than accept the motion as revised. And I understand that Jeff doesn't want to attend the Calipers Conference in Los Angeles. Other than that, I need a first and a second.
Ready to vote? All votes are in.
Thank you.
All right. That brings us to questions and comments from president, trustees, and staff. I would invite Greg to make any comments about, I think we have another upcoming board retreat as more traditional nature.
We do. I would like to remind the board and staff that we have an upcoming board retreat this coming Wednesday, February 20th. It'll be up at Balboa Park at the Prado. And our day together will be, I'm shooting for about half a day, but focusing on planned governance. Would really like to kind of relive and remember all the great lessons learned that this organization has gone through over the past 10 to 15 years. With that, I'd also like to leverage that into talking about establishing some SDCERS values. We have some of them kind of inferred, but we've never, as an organization, formally said these are our values and what do they mean to the organization. Also touch on strategic planning. It's hard to believe another year is just sped by. So we're going to be looking at a budget coming up, and we want to do some planning with regards to any type of strategic direction we're going to go. And I'm really excited that Liza has lined up some economic insights from Dr. Malin with Allianz. So he'll be coming in and trying to help us as we navigate through these perturbed markets. Also, if I may, I'd like to recognize 3 staff for some events. I wanted to recognize Susan Youngflish. As you know, she's our Associate General Counsel and Privacy Officer for attaining her certification in Information Privacy Management. Congratulations. That's very important because she does serve as our privacy officer, so I appreciate you taking that role very seriously.
I think Mark Zuckerberg was asking if she might have some spare time.
Also wanted to recognize Liza, our Chief Investment Officer. This past December, she was a panelist at the CIO Roundtable at the California Institutional Forum. So thank you, Liza, for actively participating in our pension community. And I wanted to give a brief shout out to Jessica Packard. So Bobby had held up this wonderful CAFR, which Ted's responsible for the inside, but Jessica's responsible for the outside.
It's a really nice
And so
yeah.
it was her creative genius that came up with regards to showing a symbol of the city or our community, and having the Pasadena trolley, or excuse me, the San Diego trolley. I almost said port, but I know that wasn't right. Having the trolley come around the city, and it's part of the kind of analogy of on track for retirement security. So thank you very much,
It's a beautiful
Jessica.
cover. Yeah.
And can we edit the video when this goes up? That would be awesome.
We're already over it.
And with that, I have no other comments. Thank you.
Thank you, Greg. Any other trustees wish to make any further comments? All right. I want to thank everybody for what I think was a very productive meeting.
Val, I think we have about 5 to 10 minutes in closed session, if you will.
All right, and then what we'll do is, we don't have any non-docket items. Then we'll adjourn into closed session. Johnny's going to give us a closed session presentation and report out.